Okay, welcome. This is second part of CA Inter Marathon. Okay, in the first part, we were done with some good chapters which may cover 40 to 50 marks in the examination, and it carries around it is for 7 hours. And now today, okay, we are going to watch another 7 to 8 hours content, so that entire auditing marathon CA Inter, okay, it is for 15 hours, okay, not more than 15 hours. Okay, I'll try to keep as simple as possible, and it is very important for examination point of view. Okay, done. So first of all, let me thank you for watching part number 1 and coming to part number 2. Okay, I hope you all watched part number 1 and ready with the revision also. Now before going into part number 2, from my side there is one small request. Okay, so in the part number 1, okay, which was previously uploaded on my YouTube channel, okay, if you watch that completely, okay, from my side there is one request for you. Okay, go and comment there whether it is positive or negative, or whatever you feel. If it is helpful for you, go and comment there. If you are facing any difficulty or any concern is there from your side, you can just let me know in that comment box, so that I'll rectify myself in the coming marathon sessions of various subjects. Okay, I'll be making the marathon sessions for EAS, SM also, and FM also, and even for GST or okay, or law of group 1. Okay, maybe these are applicable for November 2022. Okay, so that new students, whoever okay visiting to my YouTube channel, they'll come to know whether to use this lecture or not. Is the lecture helpful or not? Okay, for that purpose I just want old students to comment there. Okay, whether it is good or bad, you can just go on and you can just comment there, so that it will be helpful for new students. Okay, whether to come to a conclusion whether to go ahead to watch the video or not. Okay, that is for their sake, and even there won't be any monetary benefit for me to okay regarding these lectures. I won't get anything from these lectures. It is just for student purpose, and it is just my request from my side for new students who can decide upon it, okay, whether to watch or not. Okay, let me go to part number 2, starting with standards. Starting with, it's not standard, in fact it is a chapter. It is a chapter, audit sampling, chapter number 7, audit sampling. So it is covered under sampling. It is covered under standard number 530, SA 530. So before moving into the standard, let me draw one chart for you. Previously we have okay drawn this one actually. So audit procedures are two types: RAP, FAP. What is FAP? FAP, further audit procedures. Further audit procedures are divided into test of controls, and second set is substantive audit procedures. I am directly writing it as test of details. Okay, and another part, substantive analytical procedures, was done in the done previously in the previous video, and it is for 45 minutes, SA 520. So now we are into SA 530, where we have test of controls and test of details, where this test of controls can be applied on class of transactions, account balances, and okay disclosures. Test of details also will be the same. So class of transactions, account balances, and disclosures. And now we know that there may be n number of controls which may be implemented by the management in the transactions which form part of COT, transactions which form part of AB, or in case of notes to accounts also. Okay, so now some of the examples are authorization of sales, okay, authorization for purchase of assets, okay, and COT, sale authorization for sales. See, these are what, this is authorization, comes under test of details. Now under TOD we need to check up sale invoices, okay, asset invoices or title deeds, etc. These are the examples for this TOC and TOD. Now as an auditor, okay, while you conduct the audit of the same, there may be some inherent limitations. Auditor cannot verify all the transactions at one go because okay, because of lack of time constraints are there. This is called as inherent limitation of audit. For that purpose, auditor okay may not verify all the transactions. Instead of that, he can use the technique called as audit sampling, so that instead of verifying all the transactions, he will be only verifying few transactions. Based upon that, after checking that few transactions, he will be applying that opinion on the entire financial statements. Okay, now let us try to understand sampling. What all about sampling? Okay, sampling is nothing but normally imagine, okay, this is the population, this is the entire transactions of 1 lakh transactions are there. Okay, on these 1 lakh transactions, auditor needs to apply audit procedures. There are 7 procedures as we discussed, and after verifying this 1 lakh transactions, he will be able to, okay, form a conclusion whether they are right or wrong, whether the financial statements show true and fair way or not. This is what it is. But however, 1 lakh transactions he cannot verify. For that reason, what auditor can do? Auditor can, okay, select a sample from the entire population. He needs to apply the audit procedures on this sample, and he can, okay, he can conclude on the audit population. So he is doing work for sampling, okay, sample transactions, and he is concluding an opinion on entire population whether it is right or wrong. This is what called as audit sampling. Okay, audit sampling. Now there are 2 types of audit samplings. 2 types. Point number 1, systematic, or it is not systematic, it is statistical sampling, non-statistical. So what is statistical? Statistical sampling is nothing but it is a system of selecting the transactions based on random sampling, technique. Okay, random sampling technique. What is random sampling technique? So that each and every transaction which is there in the, okay, there in entire population will have the equal chance of getting selected. Okay, and this random sampling technique is supported by what? Probability theories, okay, and high level statistical formulas, okay, to measure the risk and act accordingly. Okay, this is called statistical sampling. Statistical sampling is nothing but random sampling technique, okay, based with what? Okay, it is supported by what? Probability theories and high level statistical formulas. Okay, so okay, we have listened to something called as mean, medium when we were studying in foundation. Okay, foundation, mean, medium, risk, so that it is shown as variance or standard deviation, etc. Okay, so all those formulas we use for the purpose of selection of the sample. Okay, for the purpose of selection of sample, it is called as statistical sampling. Okay, using of probability theories we are selecting the sample. It is called as statistical sampling. What are the advantages of the same, sir? When I ask you one question called as, okay, how much the sample should be? Okay, if the population is more, then sample size also shall be more. Okay, right, this is what we may conclude. But however, when we use statistical formulas, okay, as it is supported by the probability theories, okay, so when the population increases, sample size doesn't increase. Okay, the sample size doesn't increase when we follow this statistical technique, because it is already backed by what? It is backed by probability theories and statistical formulas for the purpose of selection of, okay, samples, and along with the risk also will be measured, and reaction will also be there as per the risk only. Okay, we do the work based on formulas, scientific formulas. Okay, then this is statistical. Coming to second side, it is called as non-statistical. Any kind of sampling which is having the characteristics other than statistical, okay, is called as non-statistical. Now, non-statistical, so not having previous characteristics. What are the previous characteristics? These are the previous characteristics. Okay, it is not sampling, it is random sampling, it is not probability theory, it is not statistical formulas, etc. It cannot be measured, it cannot be measuring the risk, etc. Okay, these are called as what? Non-statistical formula, non-statistical sampling. So out of these two, both can be used. However, there is some significant advantage what we can get is, okay, when the sample size is when the population is increasing, sample size doesn't increase in case of statistical sampling, because the reason is it is having the strong basis called as probability theories for the selection of the sample. Okay, coming to the second side, non-statistical. It is based on, the selection of the sample will be based on auditor's previous experiences, auditor's previous experiences, also called as subjective basis, personal opinions, subjective basis. Say for example, in the previous year, auditor was doing the audit of the particular client. In the current year also, he is appointed to audit the same. Okay, now in the previous year, whatever the knowledge he got, say imagine there are 12 months. Okay, now in the last month there used to be some misstatements in March month. Now in the current year also, auditor may use his experience what he gained in the previous audit, and in the current year also he may choose March month as his sample so that he verifies the transactions more in that month. Okay, so based on what? Based on previous experience, on subjective basis, auditor has decided to collect sample from March month only, not from other months. This may happen. This is called as non-statistical sampling. Okay, now out of entire population, how to select the sample? Okay, what are the methods to select the sample? This is what the next question is for us. Okay, done. Next question. So first point, methods of selection of sample. First point, it is what? It is random selection. So we all know what is random selection. Every transaction in the population will get the equal chance of getting selected, and this random technique, random sampling method, will have the basis of what? Support of what? Probability plus statistics. Statistics plus scientific methods. Scientific methods are there to support this random technique. When you open MS Excel, when you use random formula for that, you can just type equal to RAND, open brackets, and keep 0 to 100, then you will get one transaction as one number from that 1 to 100. This is called random selection of any number from entire transactions or entire population. This may happen. You can just type this equal to RAND, open 0 to 100. When you click enter, then it will find some 51 or 52. Equal chance of getting selected for all the numbers between 0 to 100. It may happen. And it is not so simple. It will be backed by the probability and statistical formulas, and risk also will be measured. Because of this statistical formulas. This is random technique. Coming to second point, it is what? Systematic selection. What is exactly this systematic selection is all about? Now if the entire population consists of 1000 transactions, now auditor needs to decide how many samples he needs to take up. If auditor decides to take up 10 transactions as a sample out of 1000 population, then first of all he needs to find one number. That number can be found out by the auditor just by dividing total number of transactions by total population divided by sample size. It gives you one number called as 100. So now 100 transactions is the number we use to take up the transaction as a sample. Say now so there are 1000 transactions in the population, right? Out of 1000 transactions, you need to select one transaction. Just like that, you need to select one transaction haphazardly. There won't be any basis for that. So imagine I selected 10 as the number, 10th transaction as my haphazard selection. For that I need to add this 100. This is first, 10th one is my first selection, first sample. For that I need to add this number called as 100, which gives you 110. 110 will be my second selection. Now 110 plus 100. Let me keep my phone silent. Done. 110 plus 100 gives you 210, which will be our third selection. Like that, if you can do for remaining transactions, then 10 samples will be selected. This is called as systematic selection. So entire population will be divided by the sample size, so that we'll get the transactions gap between two selected samples. Done. This is called as systematic. Come to third point, it is called monetary unit selection, where the audit sampling will depend upon the value weighted transactions. Okay, high value transactions will be selected from the entire population. That is called as monetary unit selection. It is called as what? Monetary unit selection. Let me go to this particular chapter. Without opening the chapter, I am continuing. Yes. Data analytics. Yes. Let me show you. Okay, done. First one, it is random sampling. Second one, it is systematic selection. Third one, monetary unit sampling, where the value will be like sample will depend upon what? It is value weighted selections. Okay, selection. Point number 4, haphazard selection. What is haphazard selection? Haphazard selection is nothing but there won't be any basis for selection of the sample. Okay, no structured technique, structured way to select the sample. Okay, we don't follow any theory or method. Just like that, we can just select. And mostly auditor, based on the subjective, okay, based on personal previous experiences, he will be identifying the sample. This happens in haphazard selection. However, care must be taken by the auditor. Okay, so that whatever the transactions he select in the current year, it may not provide the management to build their predictability, ability to predict the transaction whatever it is selected by the auditor. Okay, I guess you are all getting the point. So okay, let me take some example for this. So previously in the previous year audit, I selected March month. So again in the current year, if the same March month is selected by the auditor, and in the next year, from last 4 years he has been selecting only March as his sample. Okay, now from the management side, what they will do, they will predict for the next year also the auditor will only select March month, and they will avoid the misstatements in March month. They will commit the misstatements in February. Okay, so that auditor shall to avoid these type of situations, auditor shall take care. Okay, he shall not give that ability to predict to the management. Okay, ability to predict. Okay, see, samples selected without any structured technique. Although no structured technique is used, auditor would nonetheless avoid any conscious bias or predictability. Say predictability may be different items, like there are 10 locations for my client. Say there are those locations are one in Telangana, one in Tamil Nadu, one in Kerala, one in Maharashtra, etc. Okay, every time as an auditor I am selecting only one transaction, one particular location called as Tamil Nadu, and I am verifying all the transactions there. Now what is the sample I have selected? I have selected the sample of the location out of 10 only Tamil Nadu. From last 4 years I am doing the same. Now what they will do, as a management, location where the Tamil Nadu is there, there won't be any misstatement happened. At remaining areas there will be misstatement happen. That may be possible. Okay, these kind of situations shall be avoided by the auditor. Auditor shall not provide the ability to predict to the management. Okay, I guess you are all getting the point. This is called haphazard selection. And next one is blocked selection. Okay, now what is this blocked selection is all about? Blocked selection, out of entire all the transactions, all that, say 1000 transactions, auditor decides to get 200 as sample. Okay, now when you give the serial numbers to 1000 transactions, auditor is now selecting 1 to 50 is his first block, and 200 to 250 is the second block. Okay, and 400 to 450 is the third block. Okay, in such a way is selecting all the blocks, and each block will contain certain number of transactions. So all those are grouped like 1 to 50. That group will have the similar kind of characteristics. 200 to 250 will have the similar kind of characteristics. 400 to 450 will have the similar kind of characteristics. The general tendency of that transactions will be having similar characteristics. Like we can take just small example. Okay, now there are 50 students in my classroom. Where I taught them auditing subject. Now after completing the syllabus, I just want to know how I delivered the lectures, how well the students understand the concept. Okay, so this is what I just want to check. For that reason, all this classroom, in this classroom, these 50 students sat in this position, and okay, students who are there in the first rows, they concentrate much in the classroom. Okay, they study very well. Imagine students who are there in the first rows are okay studying very well. There are 10 people in the first rows, 10 people, remaining 40 in the back side. They won't come to the college regularly. Okay, whenever they want, they come, they listen, they go out. This is what happens regularly during the classroom. Now after the syllabus is done, as a teacher, I just want to know how well I delivered, how well the students understood the concept. Okay, for that purpose, what do I need to do? I need to select people from different areas of the classroom, so that after selecting them, I need to conduct an examination, and I need to okay evaluate the answer papers to know the marks what they got. Okay, this is the actual procedure we need to follow. But what I did, okay, I have okay chosen one method called block selection, where I identified a block from front row, where all these people will study very well, remaining people they won't do well, and I am now applying some procedure called examination to check whether students understand okay the subject well or not in the classroom. Okay, I am now checking only those few people, one block, and all that block will contain the similar characteristic, okay, similar kind of people who study very well. Okay, all the characteristics are same in that particular block. When I when I keep some examination for them, obviously the results will be positive. Okay, now you tell me, except these 10, remaining 40 are not regular to the class, are not listening to the class well. Okay, they don't know even the meaning of audit. And now what I am concluding, just by checking these 10 students, okay, I am concluding that entire student is getting the subject very well. Okay, is this right approach? This approach is not 100% right. Okay, because what is wrong here, a sample selection is wrong. I identified only one group, where that group will have all the students who study very well, and remaining 40, okay, I just ignored. Okay, remaining 40, those students are not good for good in the classroom, and they are not knowing anything about audit. Okay, this is what happens, right? Okay, is the sample good? Sampling technique good? Sampling method good? No, because it is block sampling, and all the transactions whatever it is there in that block have similar characteristics, and checking that particular block, it may not give the right results to the auditor. Okay, this is called block technique. However, sometimes block technique or like block selection of methods may also be used by the auditor in that particular circumstances. It is up to the auditor whether to use or not. Okay, done. So these are the methods to select the sample. Now let us go to the next aspect called as we are done with meaning of audit. See, meaning of audit sampling, we know the meaning of audit sampling, where audit procedures are applied only on the sample, and we are drawing the conclusion on entire population. Okay, done. This is called as audit sampling. And what is the meaning of population? Population is nothing but it is a set of data from where we select the sample, on which we draw the conclusions on entire population. Now, so to get right sample, first of all, population must have certain characteristics. Population must be appropriate, population must be complete. Okay, population must be complete, and population must be reliable. If these characteristics are not there for the population, then obviously okay sample may go wrong. Once the sample is wrong, okay, the auditor's main purpose of getting the opinion, forming the opinion and giving the audit report may go wrong. Okay, now these are the characteristics of the population. I hope you are all understanding the point very clear. Okay, now we are done with characteristics of population, and types of sampling is also done, statistical, non-statistical, and advantages. Okay, few advantages you can just remember. Okay, the point number 1, as the population size increases, okay, what will not increase? Sample size will not increase. Point number 2, risk will be measured, calculated properly by using probability theories. Okay, these are the two main advantages of statistical sampling. The rest all you can just read, easy only, repetitive for points will be there in this particular question. Okay, done. Next one, non-statistical, it is done. The sampling which is not having the statistical characteristics is called as non-statistical sampling. Okay, and then now we are into the concept called as sampling risk. Okay, we are identifying the risk. We are identifying the concept called as risk. That too, sampling risk. Sampling risk. What exactly the sampling risk is all about? Okay, when audit is now only verifying what sample, on this sample is applying procedures, he gets some conclusion. and this conclusion is projected on what? Population. Okay, because he is not verifying entire population, he is only verifying the sample. Okay, now if the same process on this sample, what is applied? Audit procedures. Okay, if the same procedures are applied on the population, then if he gets the other conclusion, okay, what are those conclusions? We'll just discuss that. Okay, don't worry. Okay, if these conclusions, if the same set of audit procedures which are applied on the population, okay, when he gets the different conclusion, the conclusions what we get, okay, conclusions, if they are not matching, okay, when the population is subject to the audit procedures which are applied on the sample, and if there is any contradiction of the conclusions which we got for sample in the population, and that is called sampling risk. That's called as sampling risk. Okay, what kind of conclusions? Okay, erroneous conclusion, we can call it as what? Erroneous conclusions. What kind of erroneous conclusions you can get? Okay, you can apply sampling to test of controls, or you can apply sampling to test of details. Instead of verifying all the transactions, all the invoices, you may verify only few transactions, invoices. That is called as sampling happened in, okay, sampling in TOD, sampling in TOC. Okay, now, okay, what are the types of conclusions he can get? What kind of different conclusions he get? Erroneous conclusions, where when controls are operating well, okay, controls are operating well, auditor concluded those are not operating well. This is operating well, this is not operating well. Okay, he concluded this not operating well just by checking the sample. He did not verify all the transactions. He verified sample and he came to a conclusion that not operating well, but in fact what they are, okay, they are operating well. Okay, this is first conclusion, erroneous conclusion. Okay, point number 2, okay, not operating well, but he concluded it is operating well. This is second type of erroneous conclusion. Point number 3, when he verifies the test of details, there are no any misstatements. When there are no any misstatements, however he concluded there are some misstatements, or there can be other side also, there are misstatements, but he concluded that there are no misstatements. After verifying the sample, he concluded this. Okay, now if these are the 4 types of erroneous conclusions what auditor makes after checking the samples. Okay, now when they are operating well and the auditor says they are not operating well, management won't agree. Okay, now what will happen? Management won't agree and they'll ask the auditor to verify again. So what may happen for this? Because of this, okay, there may be a time waste, okay, wastage of time. Okay, in the second side also, when there are no misstatements and the auditor concluded there are some misstatements, management won't agree, and again there will be wastage of time. Okay, wastage of time. But however, for the conclusion 2 and 4, where there are no any misstatements, okay, where there are controls not operating well, but auditor concluded they are operating well. See, I told you one thing that, okay, to decide FAP, the results of TOC are very important. If the controls are operated well, FAP will be reduced. If the controls are not operated well, FAP will be increased. Okay, to what extent we need to verify the transaction, it depends on results of test of controls. Now in the controls, if the auditor fails to identify, if the auditor fails to conclude well, when everything is not operated well, and if he concludes they are operated well, okay, what will happen? Okay, if he keeps the wrong conclusion here in TOC, okay, say example, if he concludes it is operating well, in fact it is not operating well, okay, then he will plan the further audit procedures as low. Okay, when he plans the further audit procedures low, he will not be able to identify the misstatement, and obviously it will lead to what? It will lead to, okay, inappropriate opinion, which gives rise to audit risk. Expressing inappropriate opinion when the financial statements are materially misstated. So this is the effect of, okay, this is the effect of sampling risk. When the auditor is unable to test the controls well by applying sampling, okay, what will happen? He may erroneously conclude that the auditors are, okay, the controls are operating well, In fact, they are not operating well. If it happens, then he will be choosing the FAP low, and that it gives rise to what? He may not identify the misstatement. Once the misstatements are not identified, it may lead to erroneous mistake or erroneous conclusion what the auditor will get, whether the financial statements are misstated or not. This may happen. This may happen. On the second side here, when the financial statements are materially misstated, auditor, just by checking the sample, he came to a conclusion that there are no misstatements. It will automatically lead to what? Inappropriate opinion by the auditor on the financial statements. When everything is materially misstated, how can the auditor say there is no misstatements at all? So this is called audit risk. So this sampling risk may lead to what? This is called what? Point number 2 and point number 4 may lead to sampling risk. Once there is sampling risk, obviously it will lead to what? Audit risk. Because of this sampling risk, auditor will get the inappropriate opinion, and it will be communicated to the intended users through auditor's report. So this leads to what? Audit risk. Point number 2 and 4. Okay, there is other kind of sampling risk, that is non-sampling risk. Non-sampling risk also leads to the audit risk. It leads to what? It also leads to audit risk only, expressing inappropriate opinion. However, this risk is not because of sampling. This risk is not because of selection of the sample. This risk is because of inappropriate audit processes what the auditor applies. So imagine one small example I will take. Previously, in one example, okay, in the classroom I selected one block. Okay, in that block every student will study well. Okay, where this kind of selection of sample is wrong, and this may lead to what? This may lead to sampling risk, because it is the wrong selection of the sample, and based on that we are forming conclusion on entire population, which is significantly wrong in this at this particular point of time, and it gives rise to sampling risk. See, just by checking these 4, I am coming to a conclusion that entire class has been performing well, but in fact class is not performing well. Remaining 40, they are not studying well. Okay, it gives the inappropriate opinion rate. Okay, it gives the audit risk. In fact, when you convert into audit terms, it gives the audit risk, inappropriate opinion. Okay, but what in this case, non-sampling risk, what auditor does? Okay, he selected students from various corners of the classroom, and out of 50, he selected 10 students from various corners of the classroom. So sample of selection is right. However, when keeping examination, okay, just to take a cup of coffee, he went outside without taking the mobile phones from those 10 students. Now, just by looking into Google, they have written every answer so good as it is ditto in the whatever it is there in the book, it is there in their answer paper. Now lecturer came back, okay, myself came back after having cup of tea and valuing the papers. Everything is as it is copied. Okay, everything is as it is copied, and I have given the full marks for them. Sample is right, but testing procedure is wrong. I did not take, okay, from them the mobile phones. Based on that, okay, they performed well, and I came to a wrong conclusion. Again, they are doing good. Okay, this is called as non-sampling risk. Sample is good, but the process what we apply is wrong. This may lead to what? This may lead to non-sampling error, non-sampling risk. I guess you are all getting the point clear. Okay, done. See, this is sampling and non-sampling risk. Let me highlight here. Sampling risk. There are 4 instances, right? Okay, 1, 2. In this 1, 2, A, B are there. You can just read. Okay, non-sampling risk. It is not because of the risk that auditor reaches an erroneous conclusion for any reason not related to sampling risk. It is not because of the sample, okay, sample selection. It is because of what? It is because of human mistakes. It is because of misinterpretation of the sample results. Okay, it is because of relying on erroneous information. See, auditor has selected some debtors on sampling basis, and auditor applied the third party confirmation procedures, external confirmation procedures, and audit, okay, sample selection is right, but whatever the information we get from the third party, that information is wrong. Based on that information, auditor concluded and it may give rise to audit risk expressing inappropriate opinion on financial statements. That is non-sampling risk. Okay, now the next concept is sample size, sample design, size and selection. Sample design. Okay, so from population we need to select the sample, right? Okay, what is to be selected, how many transactions are to be selected? Okay, it depends on the purpose. It depends on what? It depends upon auditor's purpose. Okay, auditor's purpose. See, auditor shall consider the purpose of the audit procedures and characteristics of the population from which the sample will be drawn. Okay, now when the population is good, it is better to take some good samples. Okay, the good selection of sample depends upon the good characteristics of population. Do you agree or not? Okay, it is 100% right that good sample will come from only good population. So while designing, you need to check up the characteristics of the population, and then when designing the audit sample, the auditor's consideration includes the specific purpose to be achieved, and combination of audit procedures are that is likely to best achieve the purpose. So now before you select the sample, first decide what are the procedures you are going to apply on that. Whether you use inquiry or inspection, whether you use observation or not. Okay, so what is to be selected depends upon what procedure is to be applied. Okay, this is what you need to remember. What is to be selected depends upon what procedure will you apply on that particular sample. Okay, on that particular sample. When you want to apply observation, apply observation procedure, you need to select the sample from what? Select the sample from, okay, physical asset verification. Okay, some assets you need to identify where you need to apply observation technique. Okay, observation won't be possible for selection of invoices. Okay, say example, there are invoices for sale transactions, so on that you cannot observe. But physical verification of the asset, you can apply this procedure called as observation. So from where we need to select the sample, it depends upon what procedure you are going to apply on that. That is what you need to keep in mind. Okay, point number 1. Okay, while designing the sample, what is to be kept in mind? Point number 1, the purpose of the auditor. Okay, purpose of the auditor. Point number 2. Okay, point number 2. Which audit procedure we need to apply? Which audit procedure, okay, is to be applied? Which audit procedure is to be applied? Now the auditor consideration for purpose of audit procedure include a clear understanding of what constitutes a deviation or misstatement, so that all and only those conditions are relevant for the purpose of audit procedure are included in the evaluation of deviations or projection of misstatements. Now you believe me one thing, before the sample is selected, auditor has to decide one thing called as, okay, he needs to define deviation, he needs to define misstatement. So now we are testing the sample, and after testing the sample, okay, when you are testing the controls, okay, when you are testing the samples of test of controls, when you are testing the samples of test of details, okay, what constitute a deviation? So test of control, it is called as deviation. For test of details, it is called as misstatement. Say for example, okay, management will keep the auditor for certain management will keep the control to achieve something, so to prevent, detect, correct the material misstatement. So control operates to achieve something. If the control fails to operate to achieve something for which it has been planned for, it is called as deviation. Okay, when the control failed to achieve its purpose, it is called as what? Deviation. when you are verifying test of details, okay, doing test of details, it has to be 1 lakh, but it is 10 lakh rupees which is written in the books of accounts. This is called misstatement, right? This is called misstatement. Now, as an auditor, before you proceed with the sampling, okay, you need to decide what is called as deviation, what is called as misstatement, and based on that, when he verifies the samples, okay, whatever the conclusions he gets, okay, he needs to apply on the entire population. He needs to apply on the entire population. That we'll discuss later at the end of this session. Okay, for the time being, when designing, third point, when designing the sample, auditor needs to define what constitutes a deviation, what constitutes a misstatement. Deviation is for what? Test of controls. Misstatements is for what? Test of details. Okay, this is the third point. These 3 points you need to keep in mind. And one more beautiful point is, while you select the sample, okay, the population, okay, population may be, while you select the sample, the population may be stratified. The population may be stratified. What is called as stratified? Okay, there are, okay, 1000 transactions starting from 1 to 1000. Starting from 1 to 1000. If it is serially numbered 1, 2, 3, 4, like that, there are 1000 transactions. Now, these transactions are ranging from 1 rupee, okay, to 1 lakh. Okay, one transaction is for 10 rupees, one transaction is for 20 rupees, one transaction is for 9,999 rupees, one transaction may be 90,000 also. Okay, the range is from what? 1 rupee to 1 lakh. Okay, now all these transactions shall be classified as stratas, stratified as stratas. Okay, so each strata, this is called as what? Strata. Each strata will have a similar, okay, similarly characterized transactions. Say 1 to, okay, transactions which are ranging from rupees 1 to 10,000, 10,000 1 to 20,000, 20,000 1 to, okay, 20,000 1 to 30,000. So we are actually keeping the entire transactions into different strata. Strata number 1, 2, 3, 4, 5. In a similar way, we are doing this. Okay, strata number 1, 2, 3, 4, 5. And all the transactions ranging from 1 to 10,000 will have similar characteristics when compared to transactions of 90,000 1 to 1 lakh. Okay, I guess you are all getting the point. So all the transactions are now got divided into various stratas, and now we are applying our, okay, sampling methods on these individual stratas. We are applying some methods of sampling to select the sample from where? 1 to 10,000. Now what will happen? Large valued items are kept in strata number 10, 90,000 to 1 lakh, where what auditor can decide? He may select 100% transactions here. He may check only 25% transactions. If there are 100 transactions here, out of 100, only 25% are taken as sample. Here, if there are 100% transactions, all the 100 transactions needs to be verified, because all those are high valued items. So this is the advantage of stratification. Okay, this is what stratification is all about. Entire transactions have to be divided into what? Stratas, and for each and every strata, auditor needs to apply. Okay, he needs to apply methods of sampling to select the right sample, and he has to decide, auditor has to decide how many transactions shall be verified from which strata. In my example, 10th strata, 90,000 to 1 lakh. Okay, 10th strata, I have selected how many? 100%. All the 100 transactions I got verified. They got verified. But this is how it goes on. This is the one method of, okay, doing the sampling verification using stratification. Another one is value weighted transactions. Okay, what is that? Value weighted transactions. The significance, the sampling importance is given only for high valued items. Low valued items will be ignored. High valued items will be only selected. So that all the items which are there in the sample will have high values, and auditor can identify the misstatement in the high value transactions. Okay, the importance in this area is given only to high value transactions. This is the next point called as value weighted selection. See, stratification, other one is value weighted selection. Now we are almost at the end of the standard number 530. Okay, we are only left with sample size. there are certain factors which will influence the sample size, whether to keep the sample size high or not. Say imagine if there are 1000 transactions, in the population, how many to be verified? Is it better to verify 10 transactions, or is it better to verify 100 transactions, or is it better to verify 900 transactions? It depends upon certain factors. It depends upon the sample size. This is called as what? Sample size. The sample size will depend upon certain factors. Now you tell me one thing. Auditor, while he is starting the audit, preliminary assessment of the controls he has done. Preliminary assessment as per 315. Preliminary assessment of what? Preliminary assessment of controls. And he came to a conclusion that risk of material misstatement is high. Risk that controls are not operating well is high. Or when he is testing the controls, say imagine when he is testing the controls, his risk assessment of the auditor regarding these controls is high. Regarding this controls is high. When the risk is high, obviously he needs to verify more number of controls. He needs to increase the sample size. Now let us talk about the sample size. Generally, auditor applies the sampling technique on what? TOC. Second one is TOD. Now I am talking about TOC. The same will be applied for TOD also. Let us talk about TOC. Now you tell me, auditor's risk assessment is high in case of working of, risk assessment high in case of working of the controls. Now as an auditor, what you will do? Will you increase the size of the sample or decrease the size of the sample? When risk is more, obviously sample size shall also be more. When the sample size is more, obviously the auditor is able to get more persuasive audit evidence. More persuasive. So what is persuasive? High. It is almost conclusive evidence. More persuasive means almost conclusive. So more reliable audit evidence you'll get. Done. So when the risk assessment relating to controls is high, when the risk is high, obviously sample size will be high. The next important point is, say there are 1000 controls which are implemented by the management. Now as an auditor, you decided yes. Sometimes when 1000 controls are implemented by the management, few may not work well. So 10% of the deviation may be there. 10% of deviation may be there. It is now fixed by whom? Auditor. There may be 10% of deviation which may not affect my audit. I am ready to accept my risk up to 10% of deviation. This is called as what? Tolerable rate of deviation. If this tolerable rate of deviation is low, the auditor is not going to leave anything. That is what it means. If it is not, everything is not tolerable, that is what, even a small mistake may have a significant impact. For that reason, if the tolerable rate of deviation is very less, auditor has to verify more number of transactions, because nothing is leavable. Nothing he can leave. Now what he needs to do, if the tolerable rate of deviation is less, sample size is more. Tolerable rate of deviation is less, then sample size shall be more. Also called as, when tolerable rate of deviation is high, sample size shall be low. See, if the tolerable rate of deviation is high, sample size shall be low. Inverse relationship is there for tolerable rate of deviation. Coming to point number 3, expected rate of deviation. Before even testing the test of controls, auditor has expected some rate of deviation. He has in his mind that when I verify 1000 controls, 600 to 700 controls are wrong only. This is what his expectation is all about. When his expected rate of deviation is more, obviously the risk is more. When the risk is more, auditor has to increase his sample size, because he is already expecting a deviation. He needs to check more to identify whether they are working well or not. Then because when the expected rate of deviation is high, risk will be more. When the risk is more, obviously sample size will be more. This is expected rate of deviation. EROD. Expected rate of deviation. If it is high, sample size shall also be high. Now another beautiful point. Please listen to me very, very carefully here. Okay, now tolerable rate of deviation. What is tolerable rate of deviation? It is what minimum. Okay, minimum it is tolerable. Okay, so if it is 10%, so out of 1000, 10% is fine. There won't be any issue. Okay, audit is ready to accept this risk. It's not so significant. It is not so significant. When something which is more than 10%, he is concerned about. Okay, now this is TOD. Now there will be a concept called as actual rate of deviation also. This is what it is fixed by the auditor. Up to 10% it is okay for me. Now he needs to verify, okay, actual rate of deviation. He needs to verify actual rate of deviation, whether it is more than tolerable rate of deviation or not. Whether it is more than tolerable rate of deviation or not. Okay, I guess you are all getting the point. Clear? So to know this, he needs to first of all calculate actual rate of deviation. What is actual rate of deviation? Okay, in fact, to know the actual exact rate of deviation, he needs to verify all the 1000 transactions. All the 1000 transactions. Anyway, it is not possible. Now, he only verified, okay, 500 transactions. Okay, 500 transactions. And out of that, he identified the rate of deviation as, okay, say imagine, okay, it can be 8%, it can be 9%, it can be 12%, it can be 14%. This is what actual rate of deviation for sampled items. But exactly if he wants to identify, okay, actual rate of deviation, what he needs to do, he needs to verify all the transactions, so that he will be getting, okay, the actual rate of deviation, which will be, okay, compared with what? Tolerable rate of deviation. If the actual rate of deviation is more than tolerable rate of deviation, obviously there will be a negative impact. It shall not be like that. Okay, now as an auditor, he desires to get, okay, see, now as an auditor, see, an increase in the auditor's desired level of assurance that the tolerable rate of deviation is not exceeded by the actual rate of deviation. Okay, he desires to get that assurance that actual is not exceeding tolerable. So to know the actual rate of deviation exactly, what he needs to do, he needs to verify more number of transactions. Hence, okay, the sample size will be increasing. Okay, the same concept will be there for even test of details also, where we call here it is as misstatement, where in case of test of controls it is called as what? In case of test of controls it is called as only, okay, rate of deviation. Now it is case of TOD, it is called as what? Misstatements. Whether to check more number of transactions, more number of documents or not, it depends upon certain factors. The same scene will be repeated. Tolerable misstatement, inverse relation. Expected misstatement, increase the size. Risk of material misstatement, increase the size. Okay, the population has been stratified properly. When the population is already stratified, divided into various stratas, then obviously the risk will be already reduced, because the transactions are already got divided into various characteristics, various groups consisting of similar characteristics. Then if the risk is already reduced, then reduce the sample size also. Okay, I guess you're all getting the point clear. The next aspect, last aspect of this chapter, it is after the sample is selected, okay, auditor needs to apply audit procedures to come to a conclusion, to get the audit evidence. Audit process to get what? Audit evidence. So it is the audit evidence he gets on the sample that needs to be projected to what? That needs to be projected to, either it can be test of controls or it can be test of details, because only few samples you verified. After testing the sample, okay, you may find what? You may find some misstatements, or you may find some rate of deviation. After testing sample, you may find some rate of deviation, or you may find some misstatements also in the sample. Okay, now this rate of deviation, it is already expressed in what? 10%. It is already expressed in 10% or 20%, expressed in terms of percentages. So now if it is expressed, if it is projected on entire population, again it will be what? Again it will be 10% only. It will be 10% only. Say imagine you verified 100 transactions, you got rate of deviation as 10%. Rate of deviation as 10%. Now what are this? Okay, what are the number of transactions? 10 only. Okay, now if you verify the population 100, so this is sample, this is population. If you verify population, okay, then how many controls may be deviated? It is 100, because 10% remains constant here. Okay, even you project or not, okay, the rate of deviation when it is expressed in terms of percentages, okay, it will remain same. For that purpose, after checking the sample, after applying audit procedure on the sample, after getting the audit evidence regarding this sample, okay, in case if it is TOC, it may not be projected. So projection won't take place in case of no projection. It may not be projected over entire population, because it is expressed in terms of percentages. The same will keep on maintaining even if you project on population. For the time being, okay, when you come to test of details, okay, see, different samples you verified, and you got some misstatements. It is for sample. This misstatement which is having the magnitude of 10 lakh rupees. This is the misstatement you identified by verifying the sample. Now as an auditor, you need to project this misstatement over entire population. This is on what? This is on sample only. If on sample, if you get 10 lakh rupees, now as an auditor, you need to project on entire population to identify the magnitude of the misstatements. Is it 1 crore rupees? Is it 2 crore rupees? That is what you need to estimate now. Okay, this is called projection of misstatements what the auditor identified in the sample on entire population. This is called projection. So projection we need to consider when we project on misstatement, that is TOD. Projection shall be made in case of TOD. Projection shall not be made in case of TOC. Even if you project, the answer will remain same. Okay, I guess you're all getting the point. Okay, for examination point of view, for MCQ basis, imagine auditor selected one sample, say one transaction. On that transaction, he tried to apply audit procedure. Okay, he needs to apply the audit procedure and he needs to verify the transaction. However, in any circumstances, if the auditor is unable to apply the audit procedure on the selected item, okay, then he may apply the audit procedure on replacement item. Say for example, I just want to verify, okay, checks, authorization on checks. There are various checks which are there, okay, serially numbered. Okay, there are 100 checks which are available. Out of 100 checks, I selected sample of 41st check. And after getting that 41st check, this check has been already cancelled. This is not an operation, in fact. Now, to apply some procedure to verify the authorization, this is the procedure I just want to check. See, to verify the authorization, I need to inspect the check. I am doing that. Okay, when I inspect the check, this check has been already cancelled. So now this procedure called inspection, okay, is not able to be applied on what? On that selected check called as 41st check. Now what an auditor needs to do? He needs to replace this 41st check with another check called as maybe 42 or even 50 or 60. Okay, he may identify the replacement item, and this procedure called as inspection for the purpose of checking this authorization has to be applied on replacement item. Okay, if in any circumstance, okay, if the auditor is unable to apply the audit procedure on the selected item or on the replacement item, then that will be deemed as in case of test of controls, that will be deemed as what? Rate of deviation. In case of test of details, that will be deemed as what? Misstatement only. He tried to verify, but he is unable to apply the audit procedure on that. Say he identified sale invoices numbered 101. He asked the management, they failed to give this. They said it is lost. Okay, then he needs to treat this as misstatement only. Okay, he needs to treat this as misstatement only. In case If this is happened, okay, in case of test of details, then he needs to treat that as rate of deviation only. He needs to consider that when calculating rate of deviation. Okay, I hope you're all getting the point here. Okay, when he is doing the audit, okay, when he verifies the sample, say imagine out of 1000 he verified 100. So out of 100, when he is applying the audit procedures, if he identified any transaction, called as anomaly, okay, anomaly means something which is significantly different from others. Now you tell me, is this 100 a representative of population or not? Yes. Okay. Out of this 100, if I identify any 10 misstatements, or deviations, these 10 also shall be representative of what? 100. In fact, it is a representative of 1000. Okay. Now, if you identify any misstatement which is significantly different from others, see, if you have identified any one transaction out of this 10, okay, which is significantly different from others, say all these are misstated at 10,000 rupees. However, only one transaction it is misstated at 1 lakh rupees. Okay, this is significantly different from others. This is only kind of transaction which is there in the entire population. Okay, now as an auditor, you need to determine whether this anomaly, okay, is having that characteristic of having, okay, of differentiating itself from others. Okay, is it really an anomaly or not? That we need to identify. Is it not a representative of entire population or not? That we need to determine. Okay, that we need to determine. For that purpose, we need to check, are there any other transactions which are, okay, such kind of nature, which are having such kind of nature. Okay, now if he determines this anomaly is significantly different from others, this transaction is significantly different from others, then he shall keep this transaction aside and he shall project the misstatements for only remaining 9. Okay, because this is significantly different. It is not a representative of the population. When it is not a representative of population, how can you project on the population? Because it is significantly different. Hence, we need to consider that separately, and you need to ask the management to rectify this misstatement. If they do not, okay, rectify such misstatement, then the auditor needs to determine whether to project that over the population or not. I hope you are all getting the point very, very, very clear. Okay, this is the concept of anomaly. Okay. So now with that, I just want to, okay, all the things are over. Okay, you can just multiple times you can just listen to this lecture so that everything will be fixed in your mind. Okay, done. So with this, I just want to wind up this session. We'll continue with the next chapter called as either it can be audit report or company audit. Okay. So already CARA 2020 was uploaded on my YouTube channel. You can go and watch there. Okay, as this first time it is given in the given in the textbook. Okay, this first time it is applicable for your examination. I discussed that in detail. Okay, there was no hurry when I was recording that class. Okay, you can just watch simply, and each and everything is given in a clear manner as a handwritten notes. Okay, done. Thank you. Let's meet after the break. Okay. Yes. Welcome back after the break. Yes. Now we'll start with one beautiful topic called as audit report. And this particular lecture, it is applicable for CA final also. Okay, whatever we study now, so it is applicable for CA final also. So in fact, whatever we studied till now, okay, from last 7 hours or 8 hours, okay, everything is there in CA final, everything. So to start CA final, we need to actually have the knowledge of the same. Okay, whatever we discussed till now, everything is relevant for CA final also. Okay, if I keep any marathon, this first 8 hours will be there for CA final also. Okay, done. Now let us talk about audit report. Only the chapter numbers are different, so rest all the topics are same. Audit report. So today in this session, for next 1.5 hour or 2 hours it may be, okay, so whatever I discuss in this next 1.5 hour 2 hours, it is every sentence is a diamond. Okay, every sentence. So this is what actually, okay, after qualifying CA we do. Okay, when you audit the same, then we'll be doing the same. Okay, when after you qualify, okay, so you'll be required to give the audit report and how this should be and what are the contents of the auditor's report. Okay, what are the wordings that we need to use in that auditor's report, etc. we need to see. Now let us try to understand auditor's report. And in this report, okay, auditor's objective is to communicate the opinion. First of all, this opinion must be formed, right? Okay, this opinion must be formed. So we'll be discussing in this particular chapter, okay, many essays. Essay 700, Essay 701, Essay 705, Essay 706, and even Essay 720 and Essay 710. Okay, 720 is not there in the syllabus of CA Inter, but it is there for CA Final. Okay, but 710 it is there for both. But today in this session I will be completing 700, 701, 705 and 706. 710 will be separately dealt after this marathon. Okay, there will be some videos on, okay, pending standards. Okay, in that particular video I'll include this 710. Okay, 710. So let us now focus mostly upon 700 to 706. 700 talks about unmodified opinion. Unmodified opinion, that is clean. 705 talks about modified. Modified will be again divided into 3 parts, right? Okay, modified is again divided into 3 parts. First one is qualified, second one is adverse, third one is disclaimer. Okay, we'll see some beautiful examples for this. Okay, don't worry. And 701 it talks about key audit matters. Okay, now 706 emphasis matter paragraph. Okay, other matter paragraph. Emphasis matter paragraph and other matter paragraph. These are the four standards we are going to see. Done. Let us start with the opinion chart. And we all know in the first session itself I have drawn this particular chart, in fact. Okay, where it talks about let me draw like this. Opinion is divided into 2 parts: unmodified, okay, second one is modified. Unmodified and modified. So unmodified opinion can be given, that is also called as what? Clean report can be given only when there is SAAE in the hands of auditor. He has sufficient and appropriate audit evidence. Okay, based on that he came to a conclusion that financial statements do not contain material misstatements. Okay, in this case he will be giving what? Clean report or unmodified opinion. Coming to the second side, modified opinion. Modified opinion can be divided into 2 parts. Okay, having SAAE, without having SAAE. Okay, having SAAE, after having SAAE in the hands of the auditor, okay, and if he concludes that there are some misstatements in the financial statements which are material in nature, okay, plus not pervasive. I explained you clearly what is pervasive in the first class itself. Not pervasive in nature, or material misstatements are there and they are pervasive in nature, okay. In these instances, if material misstatement is in existence and if it is not pervasive in nature, then we'll give qualified opinion. Here, if the auditor is having the SAAE and the material misstatements are in existence which are in pervasive nature, gives you adverse opinion. Coming to the next aspect, I'm just drawing the chart again. It was already done in the first marathon part itself. It was done. Okay, now here again when there is no SAAE and the auditor concludes that the possible effect of such misstatements, there are some misstatements which are in existence, and for that there is no SAAE, and the possible effect of such misstatements may be material in nature plus not pervasive. I'll explain the example also for this. You can just remember this for the time being. I'll explain example later. Okay, done. So material misstatement plus not pervasive gives you what? Okay, gives you what? Qualified opinion. Qualified opinion. Coming to the next aspect, it is what? Possible effect is material misstatement plus pervasive in nature. Pervasive in nature. Then in this case, disclaimer of opinion shall be given. Auditor is unable to provide his opinion because of lack of what? Because of lack of SAE, and the possible effect on that is material misstatement and pervasive in nature. Disclaimer of opinion shall be given. This is the chart which was already discussed. Now okay, all these instances must be separately discussed by way of an example. Okay, before going to that examples part, let us now talk about format of the auditor's report. Format of auditor's report. What is this format of auditor's report? Okay, every let us say example, when you want to communicate something formally, you need to have that structure in your hand, right? Like you need to know the structure of that document. Say for example, in the school level, when I was studying my 7th class, there used to be one leave letter that has to be written to the headmaster, where we need to write the date, name, and respected sir, etc. we need to write. In the Hindi subject, it used to be there. Okay, मेरा बड़ा भाई का शादी दिल्ली में होगा, इसी कारण मेरे को एक हफ्ते छुट्टी देने को कृपा करे. ओके, धन्यवाद. Okay, आपका विनम्र विद्यार्थी. This is the format we need to follow while we draft the leave letter, right? In the similar way, so auditor's report also will have a format. Okay, this format has to be complied strictly, and it is set by standard number 700. Okay, it is set by standard number 700. Whatever it is there in standard number 700 along with 705, we need to study sometimes. Okay, because standard number 700 talks about unmodified, standard number 705 talks about modified opinion, so that both of them needs to be combinedly read. Okay, for that purpose I am giving one format for you for the time being, that is as per standard number 700, as per standard number 700. So point number 1, it talks about title. Okay, title of the auditor's report. Independent auditor's report should be the title of the title of the auditor's report. Point number 2, addressee. To whom we are actually addressing this report? To the members or to the board of directors in case of internal audit. Okay, in case of statutory audit, it will be for whom? Members, shareholders. Okay, come to point number 3. Okay, this is just a basic introduction for first two side headings are basic introduction for this audit report. Now point number 3, from here onwards actual report starts. Here we talk about opinion. Here we talk about what? Opinion. And here actually we give the opinion, either it is modified or unmodified. Modified or unmodified. Okay, now later when I see the examples, when I show you the examples, okay, we'll try to understand the wordings which are to be used in this opinion paragraph. Okay, what words we need to keep in this opinion paragraph. Okay, that is what we need to understand. Point number 4. Okay, to form this opinion, what is the basis for you? On what basis you came to this conclusion whether to give modified or unmodified opinion? That is called as basis for opinion paragraph. Basis for opinion paragraph. Okay, you came to a conclusion to issue what? Disclaimer of opinion. Okay, so on what basis you came to this conclusion, that has to be written. The reasons for the same shall be written in this basis for opinion paragraph. Okay, now I guess you are all getting the point very clear. Okay, now okay, as per 700 I am writing this format, but later I will include some more text also, some more side headings in in this particular format. Okay, now for the time being, let me write here. Okay, it is what? Point number 5. After basis for opinion, we'll write key audit matters. Key audit matters. Okay, key audit matters. Okay, later we'll write here something that is called as emphasis matter paragraph or other matter paragraph. Okay, later I will try to explain that. For the time being, you just need to copy this. So basis for opinion paragraph and key audit matters. Basis for opinion paragraph and key audit matters. And let me write here. Okay, there is something I need to add here. Later I'll write. Okay, say for example, I'll later add here emphasis matter paragraph. Okay, this is when I discuss standard number 706, and there will be one case called as going concern paragraph also. Okay, only when standard number 570 is applicable, only when standard number 570 is applicable. Okay, this is not mandatory point. If this is applicable, then you need to write this going concern paragraph, and it must be before key audit matters paragraph. If nothing is specified, when going concern paragraph is not to be included, then directly come to key audit matters paragraph. I guess you are all getting the point clear. Okay, so now after that, other information, you need to write other information. Okay, and then you need to write, this other information is as per standard number 720. Okay, and then you need to write management's responsibility. Point number 8, auditor's responsibility. Point number 9, other reporting responsibilities. Simply saying, it is called as other reporting responsibilities, will be called as in that other reporting responsibility, we can call it as report on other legal and regulatory requirements. Legal and regulatory requirements. Here we need to just understand one point called as 143 subsection number 3 of Companies Act 2013 asks you to specify, to write something in the auditor's report on some points. Okay, around 10 points are there, 9 or 10 points are there. Okay, where in that we need to write, what are the points specified there, we need to signify. We need to write here in this paragraph called as report on other legal and regulatory requirement. This will form part of the original auditor's report, because it is one of the paragraphs of what original auditor's report. Or also you can do what, 143 subsection number 11 Caro 2020. All the 21 points clauses shall be there as a part of this. However, they shall be given as an annexure. It shall not form part of the original auditor's report. However, the original audit report shall be annexed with this particular report called as 143 subsection number 11 Caro 2020. I guess you are all getting the point. This is other reporting responsibilities under the side heading called as what, report on other legal and regulatory requirements under 143 subsection number 3, under 143 subsection number 11. If it is a company. I hope you are all getting the point. Now come to 10th one. It is what, signature. It is signature, point number 11. Place, point number 12. Date. It must be the signature of the member actually who is signing, and in the individual name he needs to sign, and along with that, in case if he is representing a partnership firm, under the name of the partnership firm also he needs to sign. Now next point, it is place, where it is actually signed. We need to write the place where it is actually signed. And next one, date of signing. Everything must be written, SPD. Signature, place, date. And next one is point number 13. Now it is recently added, it is called as UDIN. It is a kind of number. It is a number which is given for each and every attestation. When CA signs any particular document, when he provides his attestation services, he needs to generate one number called as UDIN. It comes under ICAI. This is regulated under ICAI, and they will give you one number, and that number shall be attested, attached to this particular attestation. So this is in order to avoid the situations of forgery some non-CAs are actually signing the certificates, doing the attestation services. To avoid those type of situations, okay, now each and every chartered accountant who is attesting any documents shall be given he needs to apply for this number called as UDIN. Okay, UDIN. Okay, this is mandatory now. Okay, this is the format we need to follow. This is the format we need to follow. Now we'll go to the opinion paragraph. Let us just a minute. We'll go to the opinion paragraph. Okay, done. So title, address, opinion, basis for opinion, and key audit matters and other information, management responsibility, auditor's responsibility, other reporting responsibilities. Under other reporting responsibilities, report on other legal and regulatory requirements. Okay, 143 and 140. Okay, 143 subsection number 11 and 3. And next one is signature, place, date, and UDIN. Okay, now let us now try to understand this opinion paragraph. Let me go to the material ones. Audit report chapter I am just opening now. See, okay, this is the title. This is the title. See, report of an independent auditor. Point number 2, addressee. So normally the addressee will be whom? Okay, it is what? It is shareholders. Addressee will be shareholders to whom we are writing this auditor's report, to whom we are addressing actually. Okay, this has to be the second point. Come to point number 3. It is auditor's opinion under the heading called as opinion. So in that, what we need to write, in fact, we need to write few things called as, okay, first of all, we need to identify the entity whose financial statements have been audited. Say we need to write financial statements of particular X Limited is been audited. That is what we need to write there. Identify the entities whose financial statements have been audited and state the financial statements have been audited. Right there, these financial statements have been audited, and refer the title of each financial statement, that is balance sheet or P&L account, cash flow statement, etc. That names must be there. Okay, later I will read the opinion paragraph before you. Okay, and then we will be able to understand, okay, much more clear way. Okay, done. Next one, identify the title of each, that is okay. Refer to the notes to accounts. Okay, then specify the date or period covered by each financial statement. So as we know, balance sheet is as on date, P&L account is for the entire year starting from April 1st till 31st March. Okay, that we need to write here. This is opinion paragraph. Okay, now when it is an unmodified opinion, it shall be expressed with the following words. Let us now try to understand one important concept called as, okay, financial reporting framework. Okay, now as an auditor, you are required to form an opinion on the financial statements, and those financial statements have to be prepared by the management. Okay, while preparing these financial statements, management will have one framework, right? One framework. Okay, they need to follow something, comply with something. Okay, framework. Okay, this is called as financial reporting framework. Financial reporting framework. Normally, framework is nothing but the standard we follow to prepare the financial statements, to prepare the books of accounts. In fact, okay. Now, generally, this framework is nothing but what? Okay, for the purpose of preparation of the financial statements, preparation of the books of accounts, okay, we need to have some standards. Those standards are called as accounting standards. Okay, accounting standards or Indian accounting standards. Okay, and these standards are in always compliance with generally accepted accounting principles which are there in India. Okay, so these three things we need to follow for the purpose of preparation of the financial statements. As we all know this, okay, there is a framework for preparation of the financial statements preparation key. You need to have what? Okay, one framework, and that is called as accounting standards and Indian accounting standards and generally accepted accounting principles. However, there may be some cases where, okay, it depends on the nature of the entity. If it is a company, it needs to comply with Companies Act 2013. If it is a banking company, it needs to comply with banking regulation act. Along with that, they need to comply Companies Act also. Okay, it depends on the nature of the entity you audit, or it depends on the nature of entity. They need to comply with different laws and regulations. Okay, each law and regulation may have its own structure for the purpose of presentation of the financial statements. Okay, preparation we need to have to follow with standards, Indian accounting standards, generally accepted accounting principles. However, for the purpose of presentation of these financial statements, and we all know, okay, there is one concept called as schedule number 3 of Companies Act 2002, Companies Act 2013, and it shows how to present the financial statements of a company. It shows, okay, it gives the guidelines for preparation of the financial statements of the company, or presentation. It is not for preparation, it is for presentation. That vertical format you need to follow. Okay, previously when I was studying my APCC, okay, we used to prepare the financial statements in horizontal format. Okay, now later they changed the format into vertical form. Okay, and there are many requirements as per schedule number 3. Okay, why any law may prescribe presentation formats? Okay, that is for the purpose of better presentation, that is for the purpose of better transparency, better understanding for the users. Okay, that presentation requirements, when you follow in the presentation of the financial statements, then obviously user will get better understanding of the financial statements. Okay, why is this required? Why the law or regulation required? Okay, law or regulation may require some formats for presentation. Okay, presentation of the financial statements, how to present and all, it will be there in this particular formats. Example, schedule number 3. When your client is a company, then you need to follow what? The framework for preparation, the framework for presentation also. They need to follow schedule number 3 also. Okay, now what is the advantage of preparing the financial statements as per the formats which are given by various laws? In case if it is insurance company, they need to follow IRDA. Electricity company, their law says something different. Okay, so all the laws put together, it is called as presentation framework. Whatever it is applicable, we need to follow. That is called AFRF. Okay, when it is a company, normal company, you need to follow what? For preparation framework. Along with that, you need to follow schedule number 3 to Companies Act 2013. These two put together, it is called as what? Applicable financial reporting framework. Okay, and this provides this satisfies the common user needs. Okay, that too particularly in India, because all the standards and all, Companies Act 2013, it is applicable within India. Okay, common user needs, and it is for wide public. It is helpful for wide public, general understanding of wide public. For them only these financial statements are prepared. Okay, now this particular framework is called as, okay, this entire process is called as what? General purpose framework. So in this general purpose framework, okay, it is divided into two: preparation presentation. Okay, preparation is nothing but standards and generally accepted accounting principle. Presentation is nothing but what? Law and regulation may prescribe certain formats to be completed by the company. In that format only we need to prepare. And what are the advantages for the same? If you follow that presentation, then transparency will be there. Transparency will be there. Better understanding of the financial statements will be there for the users of the financial statements. Better understanding. Okay, transparency, better understanding. Okay, fair presentation. Okay, all this put together it is called as what? Fair presentation. Better understanding, transparency. Okay, everything is called as what? Put together it is called as fair presentation. So when can you call something as fairly presented? Only when the finance statements are prepared as per the regulation, as per the law, as per the requirements of the law. Then it is called as what? Fair presentation. Now if you if I ask you one question, in case of company, are we required to follow law? Yes, we need to you need to have to follow law, and for that purpose those financial statements have to be prepared as per fair presentation only. Okay, so now if I can divide two things, see, let me take one example called as company has to prepare the financial statements and then it needs to present the financial statements. For preparation they have what? Accounting standards. So what are these accounting standards? Management needs to comply with these accounting standards while preparing the financial statements. Okay, that is called as compliance is required for the first point. Compliance framework. It is called as what? Compliance framework. When coming to second side, it is called as law or regulation, where it needs to be presented fairly. So that is the purpose. It is called as fair presentation framework. Okay, now if it is a company, it needs to have what? It needs to comply with compliance framework. Along with that, it needs to be presented as per the requirement which achieves the fair presentation framework. Both should be there. Okay, in fact fair presentation is what? It is more than compliance framework. It is not only just compliance of accounting standards. It is what? It is more than compliance. That is presentation also. So fair presentation framework includes compliance framework. Okay, now with this basic introduction, let us go deep into the topic. Okay, now see, let me read this. This may be given in the examination. Yes. What is the meaning of general purpose framework? General purpose framework is nothing but FRF which is designed to meet common financial information needs of wide range of users. That is what we discussed. And coming to second point, fair presentation framework. Fair presentation framework is nothing but that requires compliance with the requirement. Compliance is what? Compliance framework. Okay, compliance with standards. So along with standards, see, standards are required to be complied, and along with standards, okay, there may be some cases where the management need to provide disclosures beyond those specifically required by FRF. Okay, sometimes whatever it is said in the standards, okay, in addition to that standards, if the schedule 3 specifies, we need to comply with schedule 3 also. So whatever it is said in the standard, in addition to that, we need to disclose something more for the purpose of achieving fair presentation. Okay, so that may be allowed. This is the first point. Talking about what? Talking about additional disclosures. So in addition to what? In addition to complaints, okay, in addition to standards, something you need to disclose more. Take example of AS 18. AS 18 says you to say something called as related party disclosures. Okay, related party disclosures. This is said in AS 18. Now, Companies Act 2013 also, it is talking about, Schedule 3 also talking about disclosure of related party transactions and relationships. Okay, it may be something more than AS 18. So, whatever it is asked in AS 18, more than that we may disclose, we may present in the financial statements. Okay, this is AS 18 along with schedule number 3. Coming to second point, okay, it is not only in addition to the compliance framework, sometimes you may deviate from the requirements. Whatever it is required by the compliance framework, it may not be complied sometimes for the purpose of achieving what? The ultimate objective is for what? Okay, the ultimate objective is for achieving the fair presentation only. So what I need to write here, this fair presentation will acknowledge 2 points. Okay, whatever it is required as per standards. Okay, standards, more than standards, something you can disclose, that is called as what? Additional disclosures can be made more than the standard requires, and the purpose of this is fair presentation, for the purpose of fair presentation. So additional disclosures you need to disclose in the financial statements as per schedule number 3, example AS 18. But coming to the second side, it is not additional disclosure. Okay, you are actually complying the law, you are actually complying the standard, and in addition to the standard you are disclosing something more. This is called additional disclosure for the purpose of achieving fair presentation. Coming to the second side, okay, you may sometimes deviate from the compliance framework, that is deviate from the standard also. You may not comply with the standard, and this is possible, okay, only for the purpose of achieving fair presentation. Again, the ultimate objective is fair presentation. Now, why are you departing from the compliance framework? Okay, for the purpose of achieving the fair presentation. But it happens, okay, in extremely rare conditions. It is not very rare, it is extremely rare. Okay, they did not use the word called as rare situation, they used the word called extremely rare conditions, because I'll explain why it is like that. Okay, because when the law is set in India, okay, when Companies Act 2013 is set in India, when Schedule 3 is formed in India, okay, whoever developed that Schedule 3, they kept in mind everything, whatever it is required in the standards. Okay, they always try to match with what? Compliance framework. Now, presentation framework, compliance framework always will match. Something more than compliance framework will be there in presentation framework, okay, but something less than compliance framework won't be there generally. Okay, whatever it is followed by the standard, everything will be there in law also. However, they may prescribe more, but they shall not prescribe less than what is required minimum as per compliance framework. Generally, laws are framed in such a way. Because I told you one thing, at international level, IFRS is applicable. And to converge with the level of international, okay, they are now converting this normal accounting standards into Indian accounting standards to almost match with what? International level of standards, international financial reporting standards. Now, in India, what they are trying to do, they always try to achieve the international level standards, and along with that, Indian laws are also framed in accordance with that. Indian laws will also framed in accordance with that. Okay, previously 1956, why it is changed to 2013? Okay, why the formats have been changed to match with international levels? So always fair presentation and compliance framework both will always match. To some extent, fair presentation gives you more disclosures, but less disclosures is mostly not possible. So hence, in that case, in extremely rare conditions, I am not using this word extremely, it is given in your auditing pronouncement book itself. Okay, it is given in your auditing pronouncements book itself. Extremely rare conditions. As such, okay, to my mind, or I inquired with some of best faculties of India, they also told me the same. In this extremely, example for this extremely rare condition, as such, it is not came to their mind also. Okay, extremely rare conditions, I guess it is as per law. As per court. as per regulation it may happen, but as such for the time being there won't be any extremely rare situations where you can deviate with the standard. Okay, you can deviate with the standard. Okay, extremely rare conditions. Okay, so many of the faculties or many other videos, they say, okay, they may say change in method of depreciation or change in method of depreciation or change in method of valuation of the inventory. So these things, okay, generally faculties used to say to the students, but it is not like that. Even change in method of depreciation, change in method of valuation, all those are discussed in AS2 and AS10 PPE. Everything was discussed here. Okay, so when you change that, you are automatically complying with what AS2, you are automatically complying with what AS10. Okay, when you are complying, it comes under compliance framework only. When you are complying with, okay, compliance framework only. For that purpose, what I just want to highlight here is, okay, there won't be any as such, okay, example for this extremely rare conditions which may deviate from the compliance of, okay, compliance framework, compliance of standards. I guess you're all good, getting the point? Clear. This extremely rare condition, even the example is not given in the auditing pronouncement book also. They have specified extremely rare condition. They have given the example for first one. Okay, additional disclosures point, they have given the example, but extremely rare conditions example it is not given. You can find, you can search somewhere on Google also, it won't be, okay, it won't be available. Okay, I guess with this I am done with this concept called as concept called as fair presentation framework and compliance framework. Okay, now let me go to the see, this is the opinion we are going to form. When you are giving an opinion on fair presentation framework, when you are giving the opinion on the financial statements which are prepared as per fair presentation framework, imagine a company needs to follow law also. For them, they have what? Fair presentation framework. In that cases, what are the wordings to be used? Okay, in the opinion paragraph, auditor shall write, in our opinion, okay, the accompanying financial statements present fairly in all material respects. In all material respects, in accordance with applicable FRF. See, what is applicable FRF? I told you. Okay, what is applicable FRF? Either it can be what? Okay, it can be compliance with standard along with that law. That is called as applicable FRF. Now coming to the second, for the presentation and preparation. Okay, or also you can use the words called, in our opinion, the accompanying financial statements give true and fair view. Okay, in both the cases, one thing is common, that is fair. Okay, fair presentation framework. Okay, when it is fair presentation framework, you can use the words called as, okay, the accompanying financial statements present fairly. The accompanying financial statements present fairly. And point number 2, in our opinion, okay, the accompanying financial statements give a true and fair view in accordance with applicable financial reporting framework. Okay, next one, point number 2, in cases of compliance framework, in our opinion, the accompanying financial statements are prepared in all material respects in accordance with applicable financial reporting framework. See here, the second case, compliance framework. In the second case, compliance framework, just a minute. So I told you one thing, compliance framework is for what? Preparation. Okay, now the words what you use is, in our opinion, the accompanying financial statements are prepared in all material respects. Okay, I hope you're all getting the point. When can you call, okay, something as compliance with compliance framework, something as prepared in all material respects? Okay, just a minute. Okay, I hope you got the point clear. Now Now see here, in order to say whether the compliance framework is followed or not, okay, the evaluation from the auditor side, auditor needs to check, okay, to come to a conclusion whether the compliance framework is complied or not, okay, auditor needs to evaluate following points. Underline the following points, I will highlight few. Done. See whether the financial statements are prepared in all material respects in accordance with requirements of AFRF. Okay, this evaluation shall include consideration of qualitative aspects of the entity's accounting practices, including the following. Okay, now what are the following? Point number 1, financial statements disclose the significant accounting policies. So financial statements needs to disclose, that is AS1. Accounting policies, whatever it is selected, it shall be disclosed. So point number 1, if it is disclosed, it can be said that compliance framework is properly followed. Okay, point number 2, okay, accounting policies selected, applied, are consistent with the AFRF. So are consistent. So selected and applied are consistent with AFRF and are appropriate. So appropriate accounting policies are properly selected. This is point number 2. Come to point number 3, estimates are reasonable. So while preparing the finance statements, there may be some accounting estimates which are to be, okay, estimated by the management, and those estimates are reasonable. If it is reasonable, you can call it as what? Okay, compliance framework. Okay, you can call it as compliance with compliance framework. Point number 4, okay, the information which is there in FS, that is finance statements, is relevant, reliable, comparable, understandable. This is 4th point. Come to 5th point, the finance statements provide adequate disclosures to enable the intended users to understand the effect of material transactions and the events on the information conveyed in the financial statement. So what is to be underlined here? Okay, adequate disclosures which can enable the intended users to understand the effect of material transactions. Adequate disclosures are there to make them aware of the material transactions happen during the year, which is there in the which is conveyed in the financial statements. Point number 6, it is the terminology which is used in the preparation of the finance statements is appropriate. The account names which are there in the finance statements are actually appropriate. These are the 6 things we need to remember. So in addition to that, this is all compliance framework, right? This is all compliance framework. This is compliance framework points. So in addition to that, okay, there are another 2 points which needs to be considered for fair presentation. So what is to be considered by the auditor for fair presentation? Okay, the overall presentation, structure and content of the FS, that is what called as Schedule 3. Okay, and along with that, whether FS including related notes representing underlying transactions and events in a manner that achieves fair presentation. In these 2 points, they talk about what? Fair presentation. So compliance plus fair presentation. All these shall be there for company financial statements. We need to check up all 6, and along with that another 2 also for the purpose of finance statements of a company, because they need to comply with compliance framework and presentation framework also. Okay, I hope you are all getting the point clear. Okay, with this I am now jumping into the next aspect of the audit reports paragraphs. Okay, now we need to write basis for opinion paragraph. So after writing the opinion paragraph, okay, we need to write the basis for on what basis you formed this conclusion. Okay, you have conducted the audit in accordance with SA. Okay, in accordance with SA, and you have complied with the responsibilities whatever it is there for the auditor, and that responsibility has to be written in another paragraph called as auditor's responsibility. So here I will write some responsibilities, right? See here. This is the responsibility. After fulfilling this responsibility only, okay, I will be able to come to the conclusion. That is the basis. So based on what? Based on the compliance of my responsibilities, fulfilling my responsibilities, I came to a conclusion. What is my responsibility? To check the financial statements, to check the internal controls. All that will form part of auditor's responsibility. Okay. Now based on that, I came to this conclusion. That is what you need to highlight. So you can just read this. Okay, these points. Basis. Okay, but later I'll explain you along with the example also. Okay, point number 4, it is what? Basis for opinion. And come to going concern. Wherever it is applicable, auditor shall report in accordance with 570. When it is applicable, go and report there in going concern. Okay, going concern paragraph. Okay, we'll have some discussion on going concern paragraph also. Okay, normally Just a minute, I will show you the chart for that, okay, so that it is easy for you to understand. You can write the chart also there. Even for CA entry it is applicable, for CA final also. Institute material is the best material I have ever seen. Okay, giving lot of details, lot of clarity for each and every point. See, this is final material. It talks about standard number 570. Now, how standard number 570 is related to auditor's report? Now normally you know that financial statements have to be prepared on going concern assumption. Okay, when going concern assumption is not there, it is called as liquidation basis. The financial statements are to be prepared as per liquidation basis. When which assumption is not there? When going concern is not there, assumption is not there, then financial statements have to be prepared as per liquidation basis. When nothing is specified, what it means? Those financial statements are prepared as per what? Going concern assumption only. Now, as an auditor, you came to a conclusion after verifying the transactions. After verifying the financial position of the company, you came to a conclusion that the company is not having the ability to continue in future. Okay, continue in future. This is the auditor's conclusion on the going concern assumption. But management has prepared the financial statements as per going concern basis only. So, as an auditor, you came to a conclusion that what? As an auditor, you came to a conclusion that going concern ability is not there. But management has prepared. This is auditor's point of view. But management has prepared the financial statements as per going concern assumption. They have to prepare as per liquidation basis, but they prepared as per going concern basis. This is called as the assumption which is inappropriate. Okay, management has taken the assumption called as going concern, but after the auditor came to a conclusion that this assumption which is made by the management is inappropriate. Okay, then as an auditor, he needs to modify the report. In particular, he needs to give adverse report. I hope you are all getting the point. Okay, when going concern is not appropriate, auditor feels there is no going concern, but management has prepared the financial statements as per going concern basis only. Okay, then in that case, okay, it is called as inappropriateness in the preparation of the financial statements, inappropriate going concern assumption. And what auditor needs to do? He needs to modify. He needs to give the adverse report. Then in the opinion paragraph, he needs to give adverse, and in the basis for opinion paragraph, he needs to write the reasons for the same. What is the reason for the same? Okay, what is the reason? Going concern is as inappropriate. That is the reason for the same. In case if he wants to tell something more, he can just state the reasons also for the same. What causes him to came to this conclusion called as, okay, what causes him to come to this conclusion called as going concern. Going concern assumption is not appropriate. Okay, that is what he needs to write there. Coming to next point, management has properly taken the assumption. Going concern assumption is now right. Going concern assumption is appropriate this time. Okay, even the auditor is also agreeing for the same. Okay, auditor is also what is he saying? Auditor is also saying going concern is appropriate. Management has also prepared the financial statements as per going concern, okay, basis only. Both are matching. However, there is significant uncertainty. There is some huge lock is pending on the organization, say from before environmental authorities or before the labor laws, before the labor courts. There is some court case which is still pending. Okay, maybe in the next year or in the next year they may get this, okay, get the judgment from that court to close the company. So as of now, going concern is okay. Going concern assumption is right, but in future there is some uncertainty. Okay, there may be a court okay, result which may happen against the organization, then it is called as what? Going concern appropriate, but material uncertainty is in existence. Material uncertainty is in existence. Example is what? Example is court cases. Okay, pending court cases. This is called as, okay, material uncertainty is in existence. Going concern is appropriate. For the time being, auditor is right, management is right. They assumed it as right. But however, there is a material uncertainty which is still in existence. Okay, example, pending court cases. What is the example for first point? Okay, see here. Okay, there is huge losses for the company for last 5 years. Okay, there is no money. There is no money in the hands of the organization to repay the liabilities. Okay, auditor came to a conclusion that yes, this year it may be the end. Okay, it may be the end. This is the conclusion what auditor made. But management has prepared the financial statements as per going concern basis. Hence, it is called as what? Inappropriate assumption. This is first point. Now, coming to the second point, what is the example? Example is what? Okay, going concern assumption is right. Everything is going good. However, there is one pending court case where if the result comes negative, okay, then organization may have to liquidate. Okay, that is called as material uncertainty. So this is been identified by the auditor, and auditor needs to ask the management to disclose in the financial statements relating to this. What is to be disclosed? This material uncertainty has to be disclosed in the financial statements. If they, okay, see here, going concern assumption is appropriate. See here, second point, going concern is appropriate, but material uncertainty is in existence. And adequate disclosure in the material uncertainty is made in the financial statements. If it is already made, then auditor needs to unmodify the opinion. Auditor needs to unmodify. Let me write here. Okay, what is point number 1? I can divide this into 3. What is point number 1? Going concern assumption in itself is inappropriate. Going concern assumption itself is inappropriate. Coming to second point, going concern assumption is appropriate, okay, but it is having some uncertainty, material uncertainty, okay, material uncertainty, and that uncertainty has to be disclosed in the financial statements, not disclosed. Then if it is properly disclosed, give unmodified opinion. That is called as what? Clean report only, unmodified opinion. So nothing you need to highlight here. In the basis for opinion paragraph or opinion paragraph, okay, you are going to give only unmodified opinion. You are not going to give any reasons for the same. However, this shall be shown, okay, unmodified opinion. In addition to unmodified opinion, this particular point shall be shown in going concern paragraph of audit report. Going concern paragraph of audit report. I hope you are all getting the point. This is the paragraph I am talking about. Here, okay. Here, what are they talking about? See here, the going concern paragraph is there, right? In the auditor's report, there is one paragraph called as going concern. That we need to write here. What is that we need to write? See, this is what we need to write. Going concern assumption is appropriate. Material uncertainty is there, and that has to be disclosed in the financial statements. Okay, if it is disclosed, go and write what? Go and give unmodified opinion, clean report, and in addition to that, you need to write in the going concern paragraph. Okay, that existence of material uncertainty is there in the organization relating to the going concern assumption. That is what we need to write there. Okay, coming to second side, if it is not disclosed, then go and give qualified or adverse report. Again, it is modified. Okay, qualified when it can be given, material misstatement, okay, plus pervasive. If it is pervasive in nature, when this is pervasive in nature, okay, or if it is when it is not pervasive, give qualified. When it is pervasive, give adverse. Okay, qualified or adverse report he can give. Auditor needs to decide on his own. Okay, this is what it is called as going concern point, and only when it is applicable. This paragraph will be there only when standard number 7 570, standard number 570 came into picture. Okay, when everything is appropriate, when the going concern assumption is appropriate, what is to be written here? Nothing has to be specified here. Okay, now come to the next point, key audit matters. Come to the next point called as key audit matters. Now, before going into key audit matters, okay, let us talk about, before going into further paragraphs, management responsibility or auditor's responsibility, let us talk about key audit matters. And for that purpose, I need to go to standard number 701, standard number 701 directly. Okay, 701. See, I'm carefully linking everything. Yes, this is 701. Communicating key audit matters in the independent auditor's report. Okay, communicating key audit matters. So for the time being, okay, for the time being, what is key? Key is nothing but important audit matters. So in the progress of audit, while doing the audit, okay, whatever the areas in which significant auditor's attention is required, okay, significant auditor's attention is required, okay, those may be intimated to whom? Those charged with governance as per standard number 260. So there are some significant areas, significant auditor's attention is required on such matters. Those matters shall be discussed with whom? Shall be escalated to those charged with governance as per standard number 260. Okay, out of those all matters which are escalated to those charged with governance, okay, few matters shall be selected by the auditor, okay, because those are most significant, okay. So those matters are to be called as key audit matters. So carefully we need to underline few things. Okay, let us come to meaning of key audit matters. Okay, meaning of key audit matters. Those matters in the auditor's professional judgment, what is key matter? Okay, it has to be decided by the auditor by applying professional judgment. Okay, those matters in the auditor's professional judgment were of most significant. They did not use the word called as significance. Okay, significant. They used the word called as most significant, utmost priority. Okay, utmost priority. Okay, most significant in the audit of financial statements of the current period. So in the current period, when the auditor is doing the audit, okay, he identified few matters which are of most significant. Say, imagine there are 100 matters which are significant in nature, and those shall be discussed with whom? Those charged with governance. Out of this 100, identify, okay, 5 or 6 as most significant, okay, the most significant, and this shall be treated as key audit matters. Now you tell me, whatever the matters we are discussing as key audit matters, okay, whatever the matters we concluded them as key audit matters, they come from what? They come from the matters which were already discussed with those charged with governance. Okay, we discuss significant matters with those charged with governance. Okay, all the significant matters. Out of that, select most significant matters which shall be taken into key audit matters paragraph. I hope you are all getting the point. Okay, let us have some examples also for that. Okay, it is given in your ICA study material itself. Okay, it was recently introduced, 2 or 3 years back only it was introduced. Okay, now next one. So how can you select some matter as key audit matter? As an auditor, you performed the work. Okay, while performing the work, some of the areas needed significant auditor's attention. Okay, so out of those areas, okay, some are communicated with those charged with governance. Okay, out of those areas which are communicated with those charged with governance, now I am selecting, okay, key audit matters. Now you tell me, is it significant or most significant? It is most significant. How can you decide whether it is most significant or not? It depends upon few instances. Okay, the auditor shall determine from the matters communicated with those charged with governance, those matters that require significant auditor's attention. Okay, now whatever the matter, it is there in key audit matters paragraph. okay, that needed, while performing the auditor's work, that needed significant auditor's attention. He paid a lot of attention in that area. What can be the areas which needs more attention from the auditor side? That is what we are going to discuss now. Okay, so in making this determination whether it is most significant or not, whether it needs significant auditor's attention or not, okay, it depends on certain instances, certain areas. The areas which as per 315, which is considered as significant risk. As per 315, we are required to identify the risk, assess the risk. While we identify and assess the risk, whatever the area we identified as significant risk, that is to be determined as what? KAM. So point number 1, 315 high risk areas. This may be considered as what? This may be high risk areas, significant risky areas. Okay, this may be considered as what? Key audit matter. Say for example, let me take internal controls which are implemented in the organization for the first time. Organization for the first time, they have implemented many internal controls. Say for example, you can take another point also, risk of material misstatement. Previously, the company used to have pre-packaged softwares for the purpose of accounting, only accounting. Now as the locations of the client is been increased, multiple locations are there in India for our client. To integrate each and every location, they are using some customized software for integrating all the departments of the organization. They integrated HR, they integrated production, they integrated procurement, they integrated accounts also. So generally it is called as customized software. Particularly SAP, customized SAP, or it can be pre-packaged SAP also, it can be used. SAP or IFS, some beautiful softwares are there. Now for the first time, the company has adopted this particular instance called as particular software called as self-built software, which integrates most of the departments. So if it is for the first time implemented, it may be difficult for the employees to use that well, because they may not have that required knowledge for the purpose of implementing, for the purpose of doing accounting on that. So it may be the risk of material misstatement. There may be a case of risk of material misstatement because of existence of new software for accounting purpose. So that may be now selected as key audit matter, which shall be separately discussed in the auditor's report for the purpose of giving that additional information to whom? To users of the financial statement, to users of the auditor's reports. I guess you're all getting the point clear. This point number 1, areas where there is significant risk as per standard number 315. This is not only one area, these are all the recommendations. Based on these points, we need to decide whether it is a key audit matter or not, For the first instance, we discussed one point called as per 315, is it high risk or not? Coming to point number 2, areas where significant management judgment is involved. As per auditor's judgment, he identified one area where significant management judgments have been now included. See, significant auditor's judgment relating to areas in the financial statements that involve significant management judgment. So as per auditor's point of view, there are some areas where significant management judgments have to be there. Those areas can be treated as key audit matter. Say for example, there is an organization with 1000 crores assets value, planned 1000 crores planned. All of a sudden there is a fire which has been taken place, and now for the purpose of claiming insurance, management has made some estimation, some judgments, providing the value of loss. They use some work of external agencies also. To assess the loss happened to the organization. So 90% of the assets got damaged. So out of 1000 crores, 90%, 900 crores got damaged, and for that purpose they need to know estimating the loss. This management judgment is involved in this area, insurance claims. Now this may be the area with high management judgment which may be treated as KAM. Once it is treated as KAM, that shall be kept in the KAM paragraph of the auditor's report, because the auditor needs to grab the attention of the users regarding this key audit matter. Okay, point number 3. The effect on audit of significant events or transactions that occur during the period. Significant events or transactions that occur during the year. There may be huge earthquake, there may be huge fire accident, which may affect the audit, which may affect the financial statements, which may indirectly affect the audit also. There may be any significant event. There is nothing specified in particular. Any significant event, whatever it is decided by the auditor, if he concludes it as key audit matters, that shall be taken into key audit matters paragraph, KAM paragraph of the auditor's report. I guess you're all getting the point. So in determination of whether a matter is KAM or not, so 315 high risk areas, management judgment areas. Point number 3, significant event or transactions happen during the year. From these areas you need to take something called as what? KAM. Once it is decided as KAM, so where in these areas auditor shall spend some good amount of time in verifying that. See, significant auditor's attention is also required on those areas. From that he needs to select KAM, and that KAM shall be reported to whom? Intended users. And there, see, the auditor shall determine which of the matters so determined above were of most significant in the audit of finance statements of current period, and therefore are the key audit matters. Generally, revaluation of assets, valuation of financial instruments, newly implemented internal controls, anything, it can be anything, whether it is forming part of finance statements or not. See, adoption of new technology, adoption of new softwares by the banking company, if it is more, if the auditor considers it as most significant, then he may consider it as KAM. So whether it is there in the finance statements or not, it is irrelevant. You need to decide whether it is significant or not. If it is most significant, when even it is not there in the finance statements, that can be communicated with the intended users in the form of key audit matters paragraph. I guess you are all getting the point. Now what exactly we need to write there? Once a matter is identified as key audit matter, once the matter is identified as key audit matter, we need to report in the key audit matters paragraph point number 1, point number 2, in such a way we need to write. Now before you write that, there must be an introductory language. Key audit matters are those matters, introductory language. Key audit matters are those matters in the auditor's professional judgment or of most significant. That is the definition of key audit matters that we need to write in the paragraph. After that, these matters are considered as a whole, and in forming of auditor's opinion thereon, the auditor does not provide a separate opinion on these matters. The auditor is not going to provide opinion on these matters. They are identified as key audit matters itself. On those matters is not going to give any opinion separately. This is what we need to write. Whatever opinion he formed, he have already communicated in one paragraph called as opinion paragraph. That is over. That is different. So opinion paragraph is different. Base for opinion paragraph is different. Now communication of key audit matters paragraph is different. That is what we need to write. Now we are giving we are writing some key audit matters. On those key audit matters, separate opinion is not given. That is what we need to write here. So after these 2 points are written in KAM paragraph, then we need to write this called as description of individual key audit matters. Either it can be loss happened because of insurance, revaluation of the assets, new internal controls which are significant in nature, which are implemented in the organization, like huge loss for the PPE has been happened. It can be anything. If it is decided as KM, then write something. Write that in the KM paragraph. So now you need to describe that, first of all, describe that audit matter, and then you need to write how you addressed in that audit, how you verified that matter in the audit. Say imagine insurance loss, insurance claims. 90% of the assets were damaged, and now they are going for insurance claim. Okay, they estimated some loss of 900 crores. Now, who helped the management to estimate this as 900 crores? Okay, third party surveyors, they came, okay, they came and they estimated it as 900 crores. Now, as an auditor, okay, how you verified this? Okay, how you verified this? You verified this 900 crores whether it is right or wrong just by verifying the work which has been provided by the third parties. Okay, or you verified the internal controls which are surrounding these areas. Okay, based on that only you concluded the audit. And you came to a conclusion that this 90% is right, and now I am not going to modify the opinion on the same. It is separately given, that's it. Okay, it is not separately given as opinion. Okay, so how you addressed that matter in the audit? What did you do relating to that particular point? That is what we need to write. So these are the 2 points you need to write. Point number 1, what is that matter? Point number 2, how you did the audit of that matter. Both the things you need to write. If there are 4 key audit matters, write, okay, for each and every key audit matter, what is that and how you addressed, what is that, how you addressed, what is that, how you addressed. Okay, this is the way you need to report in the KM paragraph. Okay, KM paragraph. For whom this KM paragraph is applicable, sir? Okay, for whom this KM paragraph is applicable? You can write here. KM paragraph is applicable for listed companies. Compulsorily KM paragraph is applicable for listed companies. Okay, and also along with listed companies, it is mandatory. So along with that, if law requires the auditor to write the KM paragraph, even though it is not a, okay, it may not be the listed company, he needs to write. Law or regulation requires. Second point, applicability of 701, I'm trying to say. Okay, if in case if it is listed company, mandatory. Okay, sometimes even if it is not listed company, if law or regulation requires you to create that, or requires you to keep the KM paragraph in the auditor's report, you need to report. And point number 3, as per the discretion of the auditor, if he wants to insert some KM paragraph, then it is up to him. Okay, he can include. Okay, discretion of auditor at his own. Okay, he can create, he can form key audit matters paragraph in the auditor's report. This is the applicability of KM, applicability of 701. Okay, now one important point you need to understand is, audit report always specifies the paragraphs based on their importance. So first one, we started with opinion paragraph, and after that immediately you formed what? Basis for opinion. Okay, this is based on relative importance. You need to, okay, write this paragraph. First, utmost important is opinion paragraph, and after that basis for opinion paragraph. And after that, if going concern is there, write going concern paragraph here, and after that write KM paragraph here. Once you have if you are writing anything in KM paragraph, it doesn't mean it is a substitute for opinion. Okay, if it is relatively important, okay, as important as it is to be specified in opinion paragraph, go and specify there only. Don't come into KM paragraph. Because it is most significant. If you want to give any modification for the same, go to the top level, okay, top paragraph only, don't come to KM paragraph. Okay, relatively KM paragraph comes after what? Okay, the relative importance which is given to KM paragraph is after opinion paragraph only, after basis for opinion paragraph only. I guess you are all getting the point. After going concern paragraph only. Okay, after going concern only, you need to come to where? KM. I guess you are all getting the point. See, for that reason, it is not a substitute for modified opinion. It is not a substitute for going concern. See? Okay, and it is not a separate opinion on the individual matters which are there in key audit matters. It is not a separate opinion. Okay, see, 701 applies to audit of complete set of general purpose finance statements of listed entities. And in some cases, circumstances when auditor otherwise decide to communicate key audit matters. If he wants to communicate, he can communicate. This is applicability, right? Okay, and 701 is also applicable when auditor is required by the law or regulation, okay, to communicate. That is what these 3 points are. Okay, and point number 4, which is very, very important. Okay, auditor shall not include KM matter paragraph, when the auditor is unable to get the sufficient appropriate audit evidence, so that it led him to give disclaimer of opinion. When the auditor is giving disclaimer of opinion, when the auditor is not having sufficient appropriate audit evidence, based on that, he is going to give only disclaimer of opinion. In such a case, when the auditor is giving disclaimer of opinion, in that auditor's report don't include KM. So KM shall not be there in case the auditor is giving what? Disclaimer of opinion. So disclaimer, KM won't be at same place at a time. Disclaimer or KM won't be at a place at a point of time. Okay, done. So this is what I need to highlight in this particular standard number 701. Now, what is the purpose for communicating the KM? Why we are communicating this KM? Because it enhances the communicative value. Okay, because when you keep some important points where those matters needed auditor's significant attention, and those areas, if the auditor wants to communicate separately with the intended users, and he can now allowed under this KM paragraph, it increases the communicative value. It gives more transparency, it gives more additional information to the intended users, because this information may be there in the financial statements, may not be there in the financial statements. Anything can be given by the auditor when he considers that as most significant. And in the additional information to the intended users, and it assists the intended users to understand the entity and the areas of significant risk, significant management judgments. I hope you are all getting the point. This is the purpose of communicating the KM. Now I hope you are all getting the point, which is very clear for KM paragraph. If you want to learn KM, practically see the KM, you can just download annual report of any company, either it can be TCS or TCS or Reliance company, or any company for that matter, any listed company. If you can download that annual report, there will be auditor's report there, and open that auditor's report, there will be one side heading called as key audit matters. Out of that key audit matters, generally 4 or 5 matters are discussed by the auditor as most significant points. In that they'll write 2 things: what is that matter and how it is addressed in the in the given audit context. So it is up to you. You can just open and see there. It is not relevant for now in this particular marathon session. So whatever I say, it is finalized, done. So if you want to have some more knowledge, practical knowledge, you can go and download any. You can just search on Google itself. Annual report of any company, you can download and check into the auditor's report. Particularly listed company, you download, because it is mandatory for them. Now there may be some instances where, though the matter is key audit matter, but auditor shall not disclose that matter in the auditor's report. When the law or regulation precludes the auditor, it is prohibiting the auditor to keep that matter in the, it is restricting the auditor to keep that matter in the KM paragraph. If law is asking you not to keep, don't keep. Even though in your professional judgment it is KM, though it may be KM, but still it has to be what? Shall not be disclosed. And point number 2, in extremely rare conditions, this is also a word called extremely rare conditions, where the matter which now been communicated in the auditor's report KM paragraph, if it affects the public interest, then don't include that. Don't include that in the don't include that in KM paragraph. However, this is not applicable when that matter is already been disclosed to public. By the management itself, they have disclosed in the financial statements, and once it is disclosed in the financial statements, then there is no question on the auditor's side whether to keep as KM paragraph or not. If it is already disclosed, you also can disclose in the auditor's report. If it is not disclosed in the financial statements, if it is not publicly disclosed, and if you now disclose in the auditor's report, it will affect the public interest, then don't disclose. I hope you are all getting the point clear. There may be some instances where auditor may not identify areas which are key audit matters. He already identified. So let me ask you one question. I already asked you one question called as opinion paragraph. Under that basis for opinion paragraph, we are going to give some reasons, and even going concern material uncertainty is there. And here these are most significant. Now you tell me, out of these 3, which one is most important, highest priority? point number 1. Next important point number 2. Next important, it is most significant. These are called as key audit matters. Now you tell me, okay, for that matter, these two also normally called as key only. These two also by their nature, they are important only. They are more important than what? Key audit matters. Okay. Now except these two, if nothing is there as key audit matter which is selected by the auditor, go and write there in the key audit matters paragraph that except to the reasons which are there in going concern paragraph and basis for opinion paragraph, there is no other key audit matter which is identified by the auditor. That is what we need to write. You need to refer base for opinion paragraph, you need to refer going concern paragraph and write there except to the points which are described there. Okay, there is no other key audit matter which has been identified by the auditor. That is what you need to write here. See, okay, by their nature, 570 and 705 modification, by their nature they are what? Key audit matters only. However, in such circumstances, these matters shall not be described in the key audit matters section. Again, don't discuss that in key audit matters. Write there simply, okay, what is to be written? Okay, include a reference to basis, okay, for opinion paragraph and material uncertainty relating to going concern paragraph. Okay, include a reference right here. Okay, except to the matters which are discussed in basis for opinion paragraph and going concern paragraph, there is no other key audit matter which has been identified by the auditor in the current year, which has been identified by the auditor in this current year. That is what we need to write there. Okay, I hope you all getting the point. Communication with those charged with governance. So I told you one thing, all the significant matters are selected from those communications which are already been made with TCWG. Once you are going to write something in TCWG, write something in KM paragraph, go and discuss one more time with, okay, TCWG. Okay, this is everything is over now. Okay, I am done with standard number 701. Okay, let me again directly jump into standard number 701. 700. In 700, where are we now? Okay, in 700 I am done with what? Key audit matters paragraph. And then other information is nothing but 720. Okay, so I already told you one thing called as annual report. When you download the annual report of listed company, okay, annual report is around 300 to 400 pages. Out of that, audit report will be 10-20 pages. Okay, right, audit report will be 10-20 pages. Now annual report will contain various details. It may have financial details, it may have non-financial details also. When it is having financial details summaries which are separately disclosed than auditor's report or audited financial statements, auditor's report and audited financial statements. Okay, from this audited financial statements only they pick up some summary and they keep somewhere else in the auditor's annual report. Okay, now as an auditor you need to decide one thing, or you need to check up one thing. Is this summary also called as what? Other information. Is this other information which is picked up from the financial statements, annual audited financial statements, are they matching or not? Is there any material inconsistency? What is this inconsistency? Okay, other information is not matching with the information which is there in financial statement. Though both shall match, right? Okay, so when the management is giving separate information in the annual report which is other than audited financial statements, and if it is identified by the auditor, now, okay, what he needs to do? He needs to check, is there any mistake in the other information or is there any mistake in the annual audited financial statements? Okay, he needs to deal with it in the auditor's report if there is any mistake. Okay, that is discussed in standard number 720. More details will be given when I discuss standard number 720. Okay, done. This is relating to other information. So audited financial statements is not matching with what? Other information in annual report. Other info in annual report. Okay, done. And next one is management responsibility. You can read it on your own. Simple points. Auditor's responsibility you can read on your own. Okay, and then come to Okay, other reporting responsibilities, report on other legal and regulatory requirements. I already addressed you something called as 143 subsection number 3, 143 subsection number 11 / 2020. So it is an annexure. This shall form part of the auditor's report. Okay, done. Now signature, it shall be signed in the signed in the name of auditor's personal name, and where the firm is appointed as an auditor, report signed in personal name and name in the auditor firm. Okay, report shall be signed in personal name and the auditor's firm name, name of the audit firm also. Also mention the membership number and include wherever applicable the registration number of the firm allotted by the ICA. Registration number is also to be required to be given there. Okay, next one, place of signature. Okay, where ordinarily the city where the audit report is signed. And next one, date of the auditor's report. That date shall not be before the date of getting this sufficient and appropriate audit evidence. Okay, only after getting the audit evidence, then only you need to sign the document, right? So that date shall not be before the date of getting the audit evidence. That is date of auditor's report. And one more point, it is called as viewed in. I already explained. Come to next point. One important point as per standard number 700. Okay, there are sometimes as per FRF, there are sometimes as per FRF, as per FRF. Okay, management needs to comply with general purpose framework, okay, along with special purpose framework. In addition to general purpose framework info, they need to specify special purpose framework info also in the financial statements. What is the special purpose framework? Say, imagine if it is IFRS. Okay, normally what is accepted in India? Accounting standards. Along with accounting standards, they may require to show a statement reconciling both. Okay, showing the reconciliation. Okay, showing the reconciliation. It may be required as per the AFRF only. So AFRF is specifying the management to prepare the financial statements as per general purpose framework. In addition to that, there must be a statement which shall be included, which is showing the reconciliation between. Okay, say imagine reconciliation between P&L items. Okay, as per GPF, as per SPF. What is SPF? Special purpose framework. If it is required as per AFRF, then it is called as this additional information, additional statement, which is showing what? Which is showing reconciliation between what? GPF and SPF. Okay, if it happens as per AFRF only, then it is called as integral part. It is called as, such additional information is called as what? Integral part of financial statements. And when the auditor is expressing opinion on these financial statements, which is having the integral information, okay, it is deemed that he is providing opinion on this additional information also. Okay, then auditor is providing opinion is to be provided on okay, such additional integral info also, because it shall form part of the financial statements as specified by AFRF. Okay, I guess you're all getting the point. When AFRF specifies nothing, okay, this first case is what? AFRF specifies. When AFRF doesn't specify anything, however, financial statements, while preparing the financial statements, they prepared balance sheet as per GPF, they prepared P&L account as per GPF. Okay, and along with the P&L of GPF, they also prepared a separate P&L account under SPF also. Now it shall not be treated as, it is not this SPF, P&L account as per SPF is not to be treated as integral part of the financial statements, because it is not, okay, required by the AFRF. It is not required by AFR if it is not the integral part now. Once it is not integral part, okay, once it is not integral part, auditor's opinion on such financial statement, opinion shall not cover the same, shall not cover the integral, okay, non-integral information. So it is non-integral, shall not cover the non-integral information. Okay, that is what auditor needs to decide first of all whether it is integral or non-integral. If it is integral, then go and report on the integral information also. If it is not integral, don't go and report that one. Just restrict to GPF only. Okay, with this I am done with standard number 5. Okay, standard number 700 also. I am done with standard number 700. Okay, I went on to standard number 701. Let me talk standard number 705, which is already done in fact. 705, it is what? Modified opinion. It is what? Modified opinion. So now I am going to show you some beautiful examples of this auditor's report, the language what they used. Okay, let me go and show you the examples for the same. No. So now I am highlighting few words. See, independent auditor's report, qualified opinion. Okay, qualified opinion. See, qualified opinion. The question states you that, the question states you the following information. It is the audit of a complete set of financial statements, of a particular company, and they prepare the financial statements, as per general purpose framework, and then management responsibilities are there, everything is there. Okay, now one beautiful point you need to underline is, in the question they have given one thing called as inventories are misstated. So normally inventories have to be taken at cost or NRV, whichever is lower. However, because of non-availability of NRV, they have valued the inventory at cost itself. This is the misstatement they have done. Now as an auditor, what it is given in the question? They asked you to see the misstatement is deemed to be material but not pervasive. When it is material but not pervasive, then what is to be given? Qualified opinion shall be given. Now let me show you. While you give the qualified opinion, opinion paragraph side heading's name will be qualified opinion. If it is clean report, then go and write only opinion. Write there only opinion. If it is modified opinion, then write there qualified. Add qualified. Qualified. If it is adverse, add adverse opinion. When it is unmodified, write what? Opinion only. When it is modified, write that modification. Qualified opinion. So now one important point, what you need to identify here is, you need to write, we have audited. After doing audit only, you are providing this opinion. We have audited. So we have audited the financial statements, and it contains the statement of P&L account, statement of balance sheet and cash flow statement, notes to accounts, and all the significant accounting policies also we have verified. Everything we need to write. And after that, next paragraph, we are in opinion paragraph only. After that, we need to write, in our opinion, this is the actual opinion we are giving now. In our opinion, except for the effects of matter described in basis for opinion paragraph, except to the effect of those matters which are discussed in basis for opinion paragraph, the aforesaid financial statements give true and fair view. So it gives true and fair view except for few matters which are discussed in basis for opinion paragraph. What is that matter? Inventory misstatement. See, the company's inventories are carried at some value in the balance sheet. And management has not stated the inventories at lower of cost or realizable value, but has stated solely at cost. This is the mistake they have done. That as an auditor we are now highlighting. Because of that reason, the effect, if it is quantifiable, because when it is quantifiable, like say example, 100 crores is the cost, 90 crores is the NRV. They need to take 90 crores, they have taken 100 crores. What is the effect? 10 crores excess you are valuing your inventory. That quantification, if it is able to be done, then go and write such quantifiable details also. Quantified details also. I guess you are all getting the point. This is first, qualified opinion paragraph. Okay, what we need to write? We have audited this, we need to write, and then in our opinion, except for the effects of the matters, okay, which are described in the basis for qualified opinion, okay, except for those matters, the aforesaid finance statements give true and fair view. True and fair view. Okay, let us go to next example. Let's go to next example also. Yes, now I am going to give you adverse opinion. The example for adverse opinion. See, now I am talking about consolidated financial statements. Okay, one company is there, X Limited is there. Under X Limited, there are many companies. There are many companies. Y, Z, A, B, many companies are there. Okay. Now I am the auditor of this X Limited. Now consolidated financial statements shall be prepared. In that consolidated finance statements, we need to take up the accounts of X, Y, Z, A, B, etc. Right? Okay. Y, Z, A, B, etc. Right? Okay. For that reason, see, the consolidated, in the question they have given, the consolidated finance statements are materially misstated due to non-consolidation of one subsidiary. There is one subsidiary which is been not taken into the consolidated financial statements. It is completely ignored. It is completely ignored. Okay. Then the effect of such misstatement, because of non-inclusion of such non-inclusion of such information of the subsidiary in the consolidated financial statements. Okay. See, it is determined that the effect of the misstatement on the consolidated finance statement have not been determined because it was not practicable to do so, and adverse opinion is appropriate. Here they have specified to write you to write adverse opinion, to give adverse opinion. Now I am trying to give adverse opinion. So the paragraph name becomes what? The paragraph name becomes what? Adverse opinion. The heading for that is what? Report on the audit of consolidated financial statements. Under that we are giving a opinion called as, okay, adverse opinion. So when you are giving adverse opinion, okay, after doing audit only you need to give that opinion. So for that reason I need to highlight one word here called as, we have audited the accompanied financial statements. We have audited. Okay. Now in our opinion, to the best of the information, our information and according to the explanations given to us, because of the significance of the matter discussed, okay, for basis of adverse, the reason is given in what, where, okay, basis for adverse opinion. The reason we need to just go and refer there, okay, reason. But the accompanied financial, because of that reason, the accompanied financial statements do not read here, do not give true and fair view. Do not give true and fair view. Okay, this is what. Then come to basis for adverse paragraph, base for adverse opinion. This paragraph, okay, as explained in note number 10, this group has not consolidated one company. Okay, one company information is not consolidated. Because of what reason? Because they are unable to get the values of the subsidiaries assets. Okay, subsidiaries liabilities. Okay, it is not finalized. Hence, for that reason, they fail to add that information in the main company's information. Okay, that is the problem. Okay, so this information is therefore accounted on cost basis only. Fair values are not known. Only cost basis is known. Okay, under accounting principles generally accepted in India, group should have consolidated the subsidiary. Okay, as for age 21, we need to consolidate it, but they fail to consolidate it. For that reason, okay, for that reason, I am giving what? This adverse opinion. This adverse opinion. I guess you are all getting the point clear. Okay. Let me go to another example. So the next example is relating to what? Qualified opinion because of non-availability of the sufficient appropriate audit evidence. Okay. Qualified opinion. Now again I am talking about consolidated financial statements. Now what is that given in the question? The auditor was unable to obtain sufficient appropriate audit evidence regarding the investment in the foreign associate. The possible effects of the inability to obtain sufficient appropriate audit evidence are deemed to be material but not pervasive. So imagine there is one company called X Limited. Okay, this X Limited is having some, okay, foreign associate. There is one company which is there in foreign. In that foreign associate, this company has invested 15% stake. Okay, now whatever the profit it is there in this foreign associate, say imagine 100 crores is the profit. Okay, out of 100 crores, okay, some portion shall go to X Limited's financial statements, right? X Limited's financial statements. Okay, now first of all, you need to check as an auditor of X Limited, you need to have some confirmation of whether this profit and loss account showing 100 crores is right or wrong. If this 100 crores is wrong, obviously this 15% of 100 crores will also be wrong in X Limited. Okay, now as an auditor, you try to contact this foreign associate, try to ask the books of accounts from them, try to contact the auditors of, okay, that foreign associate, but they fail to respond. Or it is unable to the auditor. It is not possible for this auditor to talk to them. Okay, and based on that, okay, it depends on the situation. Depending upon the situation, this auditor of X Limited failed to get the sufficient appropriate audit evidence, okay, of the amount which is to be taken in the P&L account of X Limited. Okay, they are taking 150. They are taking some 15 crores. Whether this is right or wrong, this auditor, Mr. Ravi Kiran, is unable to know because he is not allowed to talk to foreign associate. Okay, this may be the reason. Imagine a case where if this investment is 90%, if this investment is 90%, see, for example, the total assets of X Limited, it is 100%. Imagine it is 100%. Out of 100%, they invested in foreign associate 10%. Okay, this investment is 10% of this 100%. Now, this may be material but not pervasive. Imagine they invested 90% in foreign associate and it is material and pervasive also. Now, if the other auditor is not providing the information, or if the auditor of X Limited is unable to get the information from foreign associate, then what will happen? In the second case, it becomes what? Material. In the second case, in the first case, it is material but not pervasive, give qualified opinion. In the second case, give disclaimer of opinion because it is material but not material and pervasive, because 90% of the assets are there in the foreign associate itself. And if you fail to verify that, then what is the point of giving this, okay, qualified or other reports? Better go and give disclaimer of opinion. I hope you are all getting the point clear. Okay, now you just need to give qualified opinion. See, again, when you are giving qualified opinion, you need to write we have audited. In our opinion, to the best of our knowledge. Okay, see, except for the possible effects. Here I used the word called possible effect. It is not the effect because we do not know. Okay, the possible effect, because we do not know. It is the possible effect because we are not having SAAE. We did not verify foreign associate books of accounts. For that reason, write possible effect. Coming to the second point, okay, you need to write whatever, okay, the matter it is there. So, foreign associate, unable to verify the books of accounts of foreign associates. Even foreign auditors are also not responding. Those reasons we need to write. If it is considered as material and, okay, and pervasive in nature, then we need to give disclaimer of opinion. Now, let us discuss about the example for disclaimer of opinion. Okay, if I discuss disclaimer of opinion, see the answer. Disclaimer of opinion paragraph I am giving. Now the paragraph starts with the word called we were engaged. Okay, it is not we have audited. It is we were engaged. Okay, and coming to we do not express an opinion, as there is no SAE, and the possible effect is what? Okay, material and pervasive in nature, so that we are not expressing an opinion on the finance statements because of the significance. Why we are not expressing? Go and refer basis for disclaimer of opinion paragraph. Okay, you'll get the understanding of the same. Why we are giving this, okay, disclaimer of opinion. Okay, we have not been able to obtain sufficient and appropriate audit evidence to provide basis for audit opinion. We are not able to form the audit opinion because of the reason called as what? Because we failed to obtain the sufficient and appropriate audit evidence. Okay, I guess you all get the point. Next one. Okay, basis for opinion paragraph, disclaimer of paragraph. Okay, now you can just read this. The reason for the same, it is given here. Okay, I guess Okay, I succeeded in explaining the differences between all the different types of auditors report. Okay, I guess it is almost 1.5 hours, 2 hours. It is more than 2 hours, I guess. Okay, done. Let us now finalize. Okay, I am done with 700, 701, 705 also. Easy only, 705 modification only. Okay, you can just read it. 706, one beautiful concept I just need to, okay, teach you now. 706, emphasis matter paragraph and other matter paragraph. Okay, lot of information is there here. So this paragraph you can read. This paragraph you can read. This chart you need to read. Now come to 706, emphasis matter paragraph and other matter paragraph. Now emphasis means what? It is stressing something, stressing on something. Okay, now let us talk about emphasis matter paragraph and other matter paragraph. Let me start with emphasis of matter paragraph. EOM. Let's talk about EOM. Okay, let me go to the meaning of EOM. Okay, it is the paragraph which is to be included in the auditor's report. In the auditor's report, we need to include one paragraph. Okay, and in that we need to refer a matter. We need to talk about some matter which is already presented and disclosed in the financial statement. Okay, I just want to highlight one point, one matter where that matter is been already disclosed in the financial statements. Okay, in the financial statements, either it can be in any note, because balance sheet, P&L account, cash flow statements will have notes, right? Notes. In the notes to accounts, point number 1, 2, 3, many notes will be there. Okay, out of that, okay, regarding one matter, I just want to highlight, I just want to write that in emphasis matter paragraph. The reason for the same is because that matter is fundamental to users understanding. It is most fundamental for the users understanding. Okay, now after doing audit, okay, after reading the financial statements, auditor came to a conclusion after applying his professional judgment that there is some matter which is there in the financial statement, and that matter needs user attention. Okay, user attention, because it is fundamental to their understanding. Fundamental to their understanding. If that is the case, then go and write in emphasis of matter paragraph. Emphasis of matter paragraph. Now you tell me one thing. Okay, so from where you can identify this EOM? EOM can be identified. Okay, emphasis of matter can be identified from the matters which are already been presented and disclosed in the financial statements. Okay, yes, there is another case where, let me write here. So EOM, okay, who asked you to write there in EOM? There is one standard called as 706. It defined EOM as the matter which is already disclosed in the financial statements. There are some other areas, there are other standards also, other standards which require the auditor to disclose that in EOM paragraph. Other standards also specify something to be disclosed in EOM paragraph. What are those other areas? See here. Okay, other essays requiring EOM paragraph. Okay, there may be one case where, while I was discussing standard number 210, preconditions for an audit, okay, when you are accepting the audit, that FRF what is been used in preparation of the financial statements must be acceptable. Okay, if it is not acceptable, the FRF it is not acceptable, the auditor has to auditor shall not accept the audit itself. When the FRF is not acceptable, auditor shall not accept the audit. Okay, first point is what? Precondition. The FRF shall be acceptable. That is nothing but it shall be general purpose framework. If it is special purpose framework, auditor shall not accept as per standard number 210 unless if it is required by law. Now for that reason, law specified the auditor to accept the audit. If law fails to specify, this would have not been accepted by the auditor at all. That is the case. Okay, if such instance is in existence, the auditor has accepted audit because of what? Because of insistence by whom? By law. by law. Okay, if that case is in existence, then go and write in emphasis matter paragraph. Go and write in emphasis matter paragraph. This is as per channel number 210, emphasis matter paragraph. And when the auditor accepted the financial statements audit which are prepared as per special purpose framework, that is standard number 800, as per that standard also we need to go and report EOM. So point number 1, okay, as per law you accepted, if not, it is not acceptable. If it is not required by law, it is unacceptable. Okay, then go and write in EOM paragraph or something like that. SA 560, subsequent events. Auditor has identified some event which is happened after the auditor's report date. After the auditor's report date, that also we need to report in EOM paragraph. This is requirements of other paragraph, and anything that can be written. Okay, say for example, some exceptional litigations are there. For that reason, we need to report the contingent liability. Contingent liability will be there in notes to accounts. That we need to highlight and report to intended users to get their attention, because it is fundamental to the user's understanding. This is as per the auditor's professional judgment. Then go and report that. Okay, and there is some subsequent event happened. So there are some early application, if it is permitted, early application of the accounting policy or early application of new accounting standard before its effective date. If it is permissible only, the management can do so. And if it does, then they need to write in the notes to accounts that what they have done. Okay, that in case the auditor wants to get the user's attention on that area, early application of the new accounting standard before its effective date, then they can do so. Major catastrophe had taken place. Major catastrophe has taken place. The significant effect on the entity's financial statement. Okay, everything whatever it is there here, it is already there in notes to accounts. And if the auditor wants to highlight that matter which is already there in notes to accounts, okay, he can go to emphasis of matter paragraph, get the user's attention on those matters, because it is fundamental to the user's understanding. Okay. Okay, now what is other matter paragraph? Other matter paragraph is the area where, see here, other matter paragraph. Now I am trying to make you understand this other matter paragraph. It is the paragraph which is forming part of auditor's report, which refers to a matter other than those presented and specified in the financial statement. If it is already presented in financial statements, then it comes under EOM. If it is not presented in the financial statements, then go to other matter paragraph. And it is not fundamental for users' understanding. It is relevant for users' understanding. It is relevant in the auditor's professional judgment. It is relevant for users' understanding of audit. 3 points you need to remember: of audit, of auditor's responsibilities, of auditor's report. Okay, on these 3 matters, if the auditor wants to get the user's attention, because it is relevant for their understanding, okay, on these 3 matters: audit, auditor's responsibility, auditor's report, he wants to say something related to auditor's report. Okay, then he can include what? He can include what? Other matter paragraph. The details are given at the end of this chapter. Okay, so what is these 3 points? Say for example, auditor is responsible for, say there is a company having 4 branches, and branches are audited by someone else. So now as a main auditor, I am not concerned related to branch audit or subsidiary audit or joint ventures audit. Okay, because I am only responsible for main company audit. This is what you need to write in the other matter paragraph, because my responsibility is for main company, because the other branches audit is being done by some other person. That is what you want to communicate to the intended users. Then you can use what? Other matter paragraph. Other matter paragraph. And believe me, writing EOM, writing in the EOM, writing in other paragraphs, it is not a substitute for 705. Okay, when the matter is so significant and it shall be taken into 705, go and write there only. It is not a substitute. Don't go and write in emphasis matter paragraph itself. Okay, you need to write there in 705. When a matter is 701, when a matter is key audit matter, okay, then go and write there. It is not a substitute here. But however, you need to remember one point: there may be some instance where one matter which is recently updated in the institute material. Okay, one matter which is covered as KAM and which is covered as EOM also, because the definitions are different. KAM Okay, significant auditor's attention. That matter got significant auditor's attention. Okay, he spent more time on doing the audit. Okay, significant auditor's attention, and he concluded it as most significant, and he decided it as KAM. It may be possible, and at the same time, there may be that matter is already been discussed in the disclosed in the finance statements by way of note number 10 or note number 9, and it is by applying auditor's professional judgment, he came to a conclusion that it is relevant. It is not relevant, it is fundamental. It is fundamental for users' understanding. One particular matter is covered as KM, is covered as EOM. Then what he needs to do? Then auditor may decide, okay, option number 1, he may add some additional text below the key audit matters paragraph and explain that. Or he can also do something, in the EOM matter paragraph also, he can write that again, okay, but as it is most important, write that matter in the first as the first point, because in EOM there may be 4 points, there may be 5 points. In those 5 points, that matter, this particular matter which is covered in KM and EOM, that shall be written first, because it is relatively significant, because it is already there in KM, because it is as significant as key audit matters. If the auditor wants to write it again, go and write in the first point of EOM. Okay, I hope you're all getting the point very, very, very clear. Okay, done. This is EOM paragraph. Rest all it is easy only. Now I'll talk about placement of emphasis matter paragraph or other matter paragraph, where exactly it should be there. Okay, so what they have specified in the standard is, now you tell me, first opinion will be there, next basis for opinion will be there, next going concern will be there, next KM will be there, okay, next other information will be there, okay, next other information will be there, next one, management responsibility will be there, auditor responsibility will be there, other legal and regulatory requirements are there. So in this sequence, where this emphasis matter paragraph must be there. Okay, so what they said, the judgment as to relative significance of such information to the intended users compared to other elements. Based on that information, we need to, based on that relative importance, we need to place that. Now for that there are some rules given. First point, when the EOM para relates to applicable FRF, see what I am trying to write in EOM paragraph. Okay, in EOM paragraph I am trying to write standard number 210, what I discussed just now. Okay, it is not, FRF is not acceptable, but auditor is doing the audit because of law. If this he wants to communicate, if it is by nature it is relatively significant, for that reason immediately after writing this paragraph, basis for opinion paragraph, okay, keep emphasis matter paragraph here. Okay, now this first point. Come to second point. When key audit matter section is presented in the auditor's report, okay, and emphasis matter may be presented either directly before or after the key audit matter section. Okay, now the auditor is asking, the auditor is asked to keep the emphasis matter paragraph either before or after the KM matter paragraph. It is as simple as that. See, when the key audit matter section is presented in the auditor's report as EOM para, an EOM para may be presented directly before or after the key audit matters based on the auditor's judgment as to relative significance of the importance. Whether to keep before or after, it depends on the auditor's judgment. Auditor needs to decide the relative importance of the same. Okay. When as per 560, if you are including the key audit, including the EOM paragraph, then you can write emphasis matter paragraph, small hyphen you can keep, and you can write subsequent event also to differentiate the emphasis matter paragraph from individual matters described in the key audit matters paragraph. Okay, so emphasis matter paragraph, in that particularly about 560 I am talking about. Okay, then you can separately write it as emphasis matter paragraph and subsequent event. Okay, done. This is the placement. Generally it may not be asked in the examination, but my conclusion is, if it is relating to 210, go and place after basis for opinion paragraph. If it is other than that, Okay, when the auditors report contain key audit matters, then auditor needs to decide whether to keep this EOM, okay, above the KM or below the KM. It depends upon the relative importance. Okay, now it is up to you to read this other matter paragraph point where to keep this. Okay, it is so simple, you can just read it on your own. It may not be asked in CA inter, it may be given in CA final. Okay, done. With this, I just want to conclude standard number 706 also. With this, I am done with auditors report, okay, chapter, auditors report chapter. So except 710 will be dealt separately, okay, as per standards part, as a part of standards. Okay, this is applicable for final and inter also. For that reason, now I am taking break. Thank you, bye bye. Okay, yes, now we can start with the next topic called as audit of banks. Okay, so we are still left with only few chapters, that is audit of different types of entities, audit of different entities. Okay, point number 2. So chapter number 2, it is audit of items of financial statements, items of financial statements. Okay, chapter number 3, audit of banks. Next part, it is IT, audit under IT environment, automated environment, pending few standards, pending few standards. These are the left topics. Now in this, I am going to start with banks. Okay, in this discussion of audit of banks, there will be around a lecture of 45 minutes to 1 hour, where I will be highlighting some important points for examination point of view. Okay, I will be giving some smart notes also for that. Okay, important points for MCQ basis also. Okay, I guess you're all getting the point. So we'll be starting with audit of banks, and then in the next session I'll be going to audit of items of financial audit of different entities, where I'll be covering, okay, I'll be covering the important areas of that, okay, chapter. So with that, we'll be done with 12 hours content. Okay, for May 2022 examination. Okay, it may be sufficient for your preparation, it may be enough to get more than 50 marks. So I am not including audit of items of financial statements and IT in this particular marathon. It may be recorded separately, but this 12 hours do not contain, okay, audit of audit of items of financial statements and IT, and I'll try to record the pending few standards also for the examination purpose. Okay, so but those lectures will be separately recorded, separately uploaded on my YouTube channel later, after once the examination is done for November 2022 students. Okay, for them I'll be, okay, attaching everything. I'll be attaching everything, and it will be for around 16 hours content, 16 to 17 hours content, which covers 100% syllabus. So for the time being, as there is lack of time, there is only, okay, 1 week time. For that purpose, I just want to restrict myself, okay, with audit of banks and audit of items, audit of different entities, few topics, and believe me, these few topics are sufficient for examination purpose, and you'll be getting some good marks only out of that. Now let us start with the discussion of audit of banks. Discussion of audit of banks. Okay, done. Audit of banks. Now we all know the operations of bank, the major operations of bank, what an audit, what a bank does, okay, in its operations. Okay, bank will accept the deposits from public, and bank will lend the loans to public. This is what the main purpose of the, okay, bank. However, these banks are divided into various types. See, first one, it is commercial bank. Okay, it is commercial bank. Second one, regional rural banks and cooperative banks, payment banks and development banks, also known as term lending institutions, and small finance banks. Okay, now let us try to understand the difference between commercial banks and all other types of banks. Okay, now I'll say some few points, okay, few points where you need to write here. Okay, commercial banks. Commercial banks, write the point whichever is okay dictated to you now. Commercial banks which provide wide range of services to general public. Commercial banks are the banks which provide wide range of services to general public. Services to general public with main functions of accepting deposits. Point number 2, and lending loans. Accepting deposits from public and lending loans to public. Okay, these two will be for whom? Public itself. Okay, now when the bank is accepting deposit, it creates the liability. In the balance sheet. When bank is providing the loan to public, and it creates the asset in the balance sheet. Okay, and okay, from this asset bank will get some income. From this asset bank will generate some income by way of interest, or there can be some assets which are in nature of investments where the bank will be getting the dividend also. Okay, later we will be discussing this. For the time being, what is the commercial bank? Commercial bank is the bank which offers wide range of products and services to public. Few of the main functions are accepting deposits from the public, which creates the liability in the balance sheet. Okay, lending loans to public, which creates the asset in the balance sheet. From that asset, bank will be getting some interest income. Later in this chapter, okay, by the end we will be discussing how to audit the income portion of this particular bank. Okay, now coming to second point, it is regional rural banks. Write a good point here. Okay, one single point you need to write. These banks are set up in rural areas. To cater the basic banking and financial needs of rural communities. These are the banks operate in rural areas which can cater the needs of rural banking requirements. Okay, now point number 3, cooperative banks. Okay, these are the banks which operate as per the cooperative principles, where this bank will collect the money from their members, and bank will be giving the loans to their members itself. Okay, this is called cooperative principles, mutual benefit principle. Okay, cooperative principle, and this must be registered as per Cooperative Societies Act or Multi-State Cooperative Societies Act. Okay, 2002. So this is cooperative bank. Payment banks are recently those are the banks which came into picture recently, where they can accept the deposits in a restricted way from public. Okay, so payment banks can accept deposits in a restricted way, but they cannot provide loans to the public. Generally, the best example for this is Paytm. It acts as a payments bank, where it can accept the deposits from public in a restricted way. Okay, unlimited money it cannot accept. However, it cannot provide the loans to the public. Okay, next one, development banks, where these are the banks which are incorporated for some purpose, called as providing loans to infrastructure projects in India. Next one, infrastructure projects. Next one, small finance banks are the banks which can which are permitted by the RBI to make available basic financial and banking facilities to unreserved reserved or unorganized sectors like small marginal farmers and small and micro businesses. Okay, so this small finance bank give loans to whom? Small farmers or small and medium scale businesses. For them, these are the banks which help provide by way of providing loans. Okay, now after this discussion, we will be able to understand the types of the banks which are there: commercial bank, rural bank, cooperative bank, payments bank, development bank, small finance banks. All these banks are now regulated by one authority called as RBI. It is the central Bank of India, where it is formed by way of an act passed by central government. Okay, now it is the regulatory body for all the banks whichever is operated in India. Okay, now this is the regulatory body. Who is the regulatory body? RBA, Reserve Bank of India. And once you incorporate a bank in India, okay, there must be many laws which are to be complied by that bank. Okay, so these are the laws which are to be complied. Point number 1, Banking Regulation Act 1949, Reserve Bank of India 1934, and Banking Companies Act, okay, 1970. SBI Act. For SBI itself, there is one act. Okay, and SBI Subsidiary Banks Act 1959, Regional Rural Banks 1976, Companies Act 2013. Anyway, once the bank is registered, it must be registered as a part of Companies Act 2013. For that reason, they need to comply with Companies Act 2013 also. And then Cooperative Societies Act 1912, because it is a cooperative societies bank. Okay, and cooperative bank in fact. Then information technology, because most of the banks run on computer basis. Okay, based on information technology only they run. For that purpose, Information Technology Act shall also be passed. It is 2000. Okay, Information Technology Act 2000 and Prevention of Money Laundering Act 2002. All these shall form part of the legal and regulatory framework. These are also will form part of that. You can just read. Okay, it will form part of the legal and regulatory framework in which the bank operates. Okay, now what are the features of the bank? All this is whatever I am discussing now, those will come under basics of banking. Okay, basics of banking. Features of the banking operation, those are high in volume, complex transactions will be there, wide geographical spread. Okay, almost in SBI 18,000 to 19,000 branches are there in India itself. Okay, and that's the next one, diversified and large range of products and services offered. There are many services which are being offered by the bank. Okay, foreign exchange, or internet banking or mobile banking. Okay, providing loans, providing different types of loans called as even funding loans or non-funding loans also by way of bank guarantee or letter of credit, etc. Okay, many products, many services are being offered by whom? Bank. Extensive use of technology, because as core banking system is implemented in India, most of the banks are now integrated. All the branches of SBI are, okay, they got integrated through one banking system, through one software called as core banking system. Okay, and then strict vigilance and compliance. As this is bank, okay, there are many laws which are applicable. Just now we discussed in the previous question, many laws, that is called as strict vigilance and compliance. Okay, they are to be monitored, banks are to be monitored. And then coming to the next point, banks shall prepare the balance sheet and P&L account as per third schedule to the act. Which act? Okay, which act? Banking Regulation Act 19, see here it is there, Banking Regulation Act 1949. Okay, as per that, see, Banking Regulation Act 1949, as per that schedule number 3 to the act, we need to prepare. Part A talks about balance sheet, part B talks about P&L account. Okay, and every bank which is preparing the financial statements, while they prepare the finance statements, they need to comply with the accounting standards whichever is recognized. Okay, whichever is notified by accounting standard or notified by section number 133 of Companies Act 2013. Okay, 2013 done. So now we'll talk about audit of banks, auditing framework. We just saw the basic introduction for banking, and now we are just required to see how the audit will be framed, audit framework which is applicable for the entity, banking entity. Now, who can audit the same? Who can audit the same? The person who audits the company will be the same person who can audit the bank also. Okay, see, balance sheet and P&L account of a banking company should be audited by a person duly qualified under any law for the time being enforced to be the auditor of a company. Okay, the person who is eligible as per section number 141 of Companies Act 2013. Okay, to be precise, a chartered accountant without any disqualifications, he will be eligible to conduct the audit of balance sheet and P&L account of the bank. Okay, now who appoints this auditor? Now, generally, because it is a company, the auditor has to be appointed in the AGM by the shareholders. However, if the bank is a nationalized bank, then the auditor shall be appointed by the bank concerned acting through board of directors. If it is a nationalized bank which is under central government, the auditor shall be appointed by board of directors. Normal bank, it is by shareholders, but if it is nationalized bank, those are to be appointed by whom? Auditors are to be appointed by board of directors. In either case, either it can be point number 1 or it can be point number 2. In either case, okay, while appointing the auditor, the approval from the Reserve Bank of India shall be taken. Approval from the Reserve Bank of India shall be taken. Now auditor of State Bank of India, though State Bank of India is also a nationalized bank, but there is separate provision for auditors of State Bank of India. See, auditors of State Bank of India are to be appointed by C&AG, Comptroller and Auditor General of India. Comptroller and Auditor General of India. I am not discussing Companies Act 2013. It is also forming part of your syllabus, but as it is covered in Group 1 law, again there is no need to discuss that particular chapter here, because everyone knows, everyone has to learn the topic in detail. It is not that required to keep a revision on that particular area. I guess you're all getting the point. For that reason, I'm not going to keep any video on Companies Act 2013, as it is already covered in Group 1, and as a student you need to learn each and every provision from that area. As this is only marathon session, only a revision session, I'm not going to take up that particular chapter now. So in that there will be a concept called as government auditor, and that government auditor has to be appointed by government company auditor has to be appointed by C&AG. In the similar way, auditor of State Bank of India has to be appointed by whom? He shall be appointed by C&AG only in consultation with central government. Now auditors of regional rural banks are to be appointed by the bank concerned with the approval of the bank itself is required to appoint the auditor of regional rural bank and with the approval of central government. Now, who fixes the remuneration? Generally, Companies Act 2013 says, section number 142 says how to fix the remuneration. The same thing we need to comply for banking company also. However, in case of remuneration for nationalized banks or SBI, it shall be fixed by RBI in case of after taking the consultation from central government. So the remuneration of State Bank of India, auditor for State Bank of India and nationalized banks will be fixed by whom? RBI. For remaining banks, it shall be fixed by section number 142 itself. Whatever the procedure we follow for section number 142, it shall be the same shall be applicable for other banking companies other than nationalized banks and the state banks, in whose case it will be the remuneration will be fixed by RBI in consultation with central government. Now we'll talk about some audit reports which shall form part of the banking company. For a banking company, auditor needs to, as an auditor, you need to issue two types of reports. Point number 1, statutory report, statutory audit report. Point number 2, long form audit report, LFAR, long form audit report. First of all, let me talk about statutory. As I already told you, every banking company, every company itself, they need to get their books of accounts audited by a chartered accountant and needs to issue the audit report also. Even in case of nationalized bank, the same thing will be continuing. So when you follow any act and if you issue the audit report, then it is called as what? Statutory audit report. Now, what is LFAR? LFAR is also a report which is in addition to the statutory auditor's report. Now it is your work to read all these points. Yesterday we discussed, in the previous class itself we discussed, in the previous class we discussed the audit report, how the audit report should be. Now in the current class I am going to give you the homework related to, as a statutory auditor, what you are going to report in your statutory audit report, what you are going to write in the statutory auditor's report. See, I'll highlight few things. You just need to, I'll highlight few things without reading. You just need to read it on your own. In auditor's opinion, balance sheet, true and fair view. And auditor had called all the necessary information, and transactions of the bank are within the powers of the bank, entered by the bank are within the powers of the bank. Returns properly received from offices or branches. Profit and loss account show true and fair view. And any other matter in which the auditor considers should be brought to the notice of the central government. These are the points on which the auditor needs to report, in his statutory auditor's report. Now coming to second point, it is an additional report which is to be issued by the auditor, that is called as long form auditor's report. Long form auditor's report. RBI will issue a format for long form audit report where the auditor needs to fill up the format and give the details to RBI. See, long form audit report has to be furnished by the auditor of the bank in addition to the normal audit report as per statutory Okay, statutory requirement. Now coming to the second point, the matters which the bank require their auditor to deal with in the form of long form audit report have been specified by whom? The matters will be specified by RBI. Now this LFRA of a particular financial year, say if it is April to May 2020, April to March 2022, LFRA shall be submitted, okay, before 30th June every year. Before 30th June every year. If the financial year is closing by March 31st, so after 31st March, whatever the date, it is called as 30th June, okay, by that date LFRA shall be submitted. Proper planning. So to ensure timely submission of LFAR, proper planning for completion of LFAR is required. While the format of LFAR does not require any executive summary, okay, but as an auditor you may need, see, members may consider providing the same to bring out the key observations from the whole document. So by itself you are not required to keep any summary of the long form audit report, but for the purpose of audit, if the auditor feels to keep, okay, if the auditor concludes to keep any key observations from the whole document, he can keep that summary at the below of long form audit report. Now this is fraud, reporting of fraud. As we all know, there is section number 143 subsection number 12, where it is reporting of fraud to the central government. Now the same will be applicable here also, okay. The same will be applicable here also. You can just read it on your own. Reporting of fraud. Now, conducting of an audit. Okay, this is also not relevant for examination point of view. And anyway, whatever we follow the normal procedure in conducting the audit, like okay, assessing the risk of material misstatement, and understanding the relevant controls, preliminary assessment, and then planning to test of controls, and then further audit procedures, and discussion with engagement team members, okay, forming an opinion on the same. So all these things will be forming part of this conduct of an audit, okay. It is not required to be discussed again, okay. Now from examination point of view, whatever it is important, okay, now I am picking up that content to discuss, okay. Now let us write how it is divided into, the syllabus is divided into in this particular chapter, okay. Now if this is the balance sheet, in the balance sheet these are assets, right? These are assets, these are liabilities. However, these liabilities portion is not there in the syllabus. These assets, how to audit this asset is given in the syllabus itself, okay. Now assets will be advances or loans given to public. This is the asset. Based on that, we need to get, the bank will get some interest, and this interest will form part of P&L account. This P&L account will have, okay, will have expenditures and will have incomes also. So the syllabus itself contains three things: how to audit the assets, how to audit the, okay, interest income or other incomes, how to audit the expenditures of the organization. Now we'll be covering the audit of assets and audit of incomes. Expenditure audit is so simple, you can read it on your own. That is what given as homework, okay. Now we'll be discussing the important points related to assets, important point related to interest also. I am going to discuss only those points which are mostly relevant for the examination purpose, okay. As we are lack of time, I am going strictly in the examination point of view, covering most of the points, giving appropriate notes for you, okay. Now, so what forms part of the balance sheet? Advances will form part of the balance sheet. That is what we are going to discuss. Now, advances are divided into different types, okay. Normally, advances shall be disclosed, okay, in different types. Point number 1, by way of nature, security, location. Nature, security, and location. See, advances can be classified as by way of nature. It can be term loan, it can be working capital loan, it can be bills purchased and discounted. And by way of security, you can call it as secured, unsecured. By location, okay, you can call it as advances, loans which are given in India, loans which are given outside India. If it is given in India, then again classify the loans as priority sector. Generally, agriculture, small and medium scale industries will be called as priority sector. Public sector, okay, advances to other banks, others. Okay, we need to classify all the advances, all the balances which are there in the balance sheet as advances in the following ways. Okay, now you tell me one thing. These advances, from these advances, bank is going to get the income, bank is going to get the interest income. Now normally as per AS 9, interest shall be recognized on accrual basis. Whether you receive the interest or not, it shall be recognized as as income in the current year itself. Whether it is received or not, it is based on time. Okay, it is based on the interest recognition is based on time. Okay, accrual basis, also called as accrual basis. Now these advances will fetch some revenue to the organization in the form of interest. Now what if these advances fail to generate some income? Okay, now these advances will be called as NPA. Someone has taken loan from a bank and they fail to repay the interest or repay the principal. If that happens, those assets are called as NPAs. Okay, now in this session we are going to look after the definition called NPA, when some asset will be called as NPA. Okay, when some asset will be called as NPA, and if that asset is NPA, based on that definition we need to classify these assets into 4 parts. Standard, substandard, point number 3, doubtful, point number 4, doubtful, and point number 4, it is loss asset. Okay, based on this definition called NPA, okay, we can just segregate total all the advances into different parts called as standard, substandard, and doubtful and loss assets. Why are we actually segregating these assets into different ways? Okay, so that we shall create a provision for the same, because if every advance is generating some income, then there won't be any provision which is required for the income. Okay, now if the advances are not performing well, then obviously the interest shall not be recognized here, because the advance itself is doubtful to be recovered. When the advance itself is doubtful to be recovered, then interest shall not be recognized in the P&L account. For that reason, we need to segregate this asset into various, we need to classify the asset into standard, substandard, doubtful, loss. Now based on that we need to recognize the income. Along with recognizing the income, we need to always create the provision also in the balance sheet. Okay, because we will write the income. However, there may be a possibility that it may not be received. On time. For that reason, we need to create the provision also. Now these are called as prudential norms, asset classification and prudential norms. Okay. Now what is the definition of norm? Norm is nothing but a rule which is given for classification of asset, a rule which is given for provisioning the income, provision which is to be taken into the balance sheet. Now let us try to understand. Let us now try to understand when something will be called as NPA. There is an asset that will be called as NPA in the following situation. See. Okay, let me give some beautiful notes for this. Let me give some beautiful notes. Okay, done. Right there, an asset will be called as NPA. An asset will be called as NPA when it ceases to generate the income to the bank. bank. Keep the down arrow mark and write. Okay. When interest or installment of principal, principal remains overdue, 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 or out of order, out of order, out of order for a specified time period, for a specified time period, for a specified time period, then that asset will be called as non-performing asset. See what they are trying to say. An asset will be called as non-performing asset when this asset is overdue, when this asset is overdue. Okay, when this asset, the income like the interest or installment repayment is overdue or out of order for certain time period, then this asset will be called as NPA. Now what is overdue? Overdue is the money, okay, which is not paid by the borrower to the bank even after the due date is fixed or due date is arrived. Okay, see here, what is overdue? The amount is said to be overdue if it is not paid on the due date. Okay, the due date is fixed by the bank and on that date the borrower failed to pay the money. Okay, then that money will become what? Will become overdue. Okay, say in case of term loan, say 10 lakh rupees, I have taken 10 lakh rupees as, okay, as principal. Now in the first month I need to pay 10,000 rupees as interest, and in the first month I need to pay another 20,000 rupees as principal repayment. Total 30,000 rupees I need to pay. Now this 30,000 rupees will become an overdue amount. Okay, say the loan is taken on 1/1/2022. The due date is fixed for repayment of this interest and the principal is 1/2/2021. First installment. Now on this date, this money of 30,000 rupees will become overdue. Yes. What is out of order? Out of order. Okay, when we can call something as out of order, some advance as out of order? First of all, let me talk about working capital loan. Let me talk about overdraft facility or cash credit facility. Where in case of term loan, let us now identify the difference between term loan and the OD. When the term loan is given, okay, so based on regular time intervals, the borrower needs to repay the money, interest along with principal. Principal and interest both shall be paid by the borrower within a reasonable interval of time. Okay, because it will be agreed by whom? Bank and the borrower. There will be an agreement where the borrower needs to pay to the bank on regular basis. They need to pay principal and interest. This is called term loan. But in case of working capital loan, what they try to do? Okay, say Mr. Ravi Kiran has taken loan of working capital loan, where using that loan he will be purchasing the asset. Let me show the balance sheet. In the balance sheet, he needs to purchase 40 lakhs worth of loan, 40 lakhs worth of stock. Okay, so to get this 40 lakhs worth of stock, he needs to first of all take the money from the bank. Now imagine it is loan account in the books of accounts of Mr. Ravi, loan account. Okay, so he has utilized 40 lakhs worth of money, from that loan account called as OD account, OD. Okay, bank is providing me 40 lakhs drawing power, and using that drawing power I can withdraw how much money? 40 lakhs money. By using that money, what I can do? I can purchase the stock worth of 40 lakhs. Okay, both the value of the loan and value of the stock both are matching. Okay, if they match, there won't be any problem. Okay, this is called what? When the stock Okay, when the sanction limit is 40 lakhs and the utilized money is also 40 lakhs, when the security is also 40 lakhs, then there won't be any problem. Okay, imagine a case where when the stock limit, okay, sanction limit is 50 lakhs, okay, but they are only purchasing the stock worth of 40 lakhs, then, okay, from this 50 lakhs, the borrower is only, okay, given a power to borrow up to 40 lakhs because he is only maintaining the security of value 40 lakh rupees. Okay, that is called as what? That is called as drawing power. Sanction limit is different, drawing power is different. This is what we discussed till now. Okay, now you understand one important point where, okay, sometimes, okay, it depends on the okay, rapport between bank and the borrower. Bank may provide sometimes more money than the sanction limit, than the drawing power. So imagine if the bank provides, okay, 5 lakh rupees more than 40 lakhs, 5 lakhs rupees in extra they have given. Okay, this is in extra, this is in addition of, okay, sanction limit. Now this 5 lakh rupees is given for temporary purpose, and this temporary purpose loan shall be repaid by the, okay, borrower. This shall be debited in his books of accounts, this is called what? Repayment of this 5 lakh rupees, which is borrowed in excess of what? Okay, 40 lakh rupees, and this 40 lakh rupees cannot, okay, is not required to be paid back. This 40 lakh rupees is not required to be paid back, okay, on a regular basis of, okay, time intervals, okay, interval of time. Okay, it can be paid, it shall be paid by the borrower only at the closure of the business itself, so regular intervals of time, okay, during that time this 40 lakhs is never paid. Okay, this is the difference between OD and the term loan. In term loan, repayment of principal will be there, but in case of OD, repayment of principal will be there only at the end of the closure of the business only. Okay, but repayment of or payment of interest will be always there. Because you have already utilized how much? 40 lakh rupees. Okay, for that the liability will be created. Interest 5 lakhs. Example, interest 5 lakhs. This 5 lakhs interest shall also be paid. Okay, this is repayment of what you borrowed in extra of the sanction limit. So second point, interest shall also be repaid. That is, it's not repaid, interest shall also be paid. That is 5 lakh rupees. Because on the credit side you are taking interest because it is adding to your liability, and that interest shall be paid to whom? To the bank, and if it is paid, it shall be debited. Because the interest which is shown as liability shall be paid first of all. Okay, now what is called as out of order? When you withdraw the amount more than what is sanctioned, okay, and if you fail to repay it, the outstanding balance will be always more than what? When you fail to repay, always more than 40 lakhs which is actually sanctioned. When is always more than, okay, what is actually sanctioned, then it is called, that account is called, how much, what is that account called as? Okay, out of order account, out of order. Second point, you are required to pay the interest. You are not required to pay the principal, this 40 lakhs. You are required to pay that 2 lakhs or that 5 lakhs, whichever is extra. Okay, but you are not required to pay 40 lakhs because this is what the OD is all about. In OD, 40 lakhs is not repaid. Okay, so from 45 lakhs, 5 lakhs to be paid immediately, but 40 lakhs shall not be paid immediately. It is paid at the end of the business only, closure of the business only. Okay, now what I am talking about? Okay, what I am trying to say. So what is out of order? Point number one, outstanding balance, okay, is always more than, if it is more than drawing power or sanction limit. Okay, that is what? 5 lakh rupees temporary loan which is drawn in extra. Okay, if it is not paid, it is called as out of order account. Point number 2, though the principal 40 lakhs is not paid, but not to be paid, but he needs to pay interest. If the interest is not paid, the interest is not, okay, debited in the books of accounts of Mr. Ravi. If it is debited in the books of accounts of Ravi, in the bank's books of accounts it is credited. Now we are talking from the side of bank. Interest is not credited. Okay, interest is 5 lakhs, that is not credited. Point number 3, interest is credited, okay, but it is not sufficient to cover the actual interest. Okay, actual interest is 5 lakhs, but interest whatever is credited is 2 lakh rupees. This is not matching. Okay, this is not matching. If this happens, then that account is called as what? Out of order account. Out of order account. And we know now, okay, what is out of order and what is, okay, overdue. What is overdue? Okay, if the account is out of order for more than 90 days, it becomes what? NPA. It becomes what? NPA. I guess you're all getting the point clear. Explain you the definition of NPA. Okay, an asset will be called as NPA only when it is, okay, overdue. The amount is overdue, or the account is out of order. The account is out of order, and we know what is out of order and we know what is overdue. Overdue is the amount which is not paid by the borrower, okay, even after the due date, which is fixed by the bank. Out of order is what we learned till now. Okay, and if these are continued for certain period, and that certain period is 90 days, and that certain period is 90 days. Now let us read this. See, NPA classification in respect of specific advances. Term loans, if it is term loan, okay, overdue in excess of 90 days. Overdue in excess of 90 days. In case of working capital loan, also called as overdraft or cash credit, the account has remained out of order for a period exceeding 90 days. Bills purchased and discounted in excess of 90 days. In excess of 90 days. See, bank has purchased a bill and paid the advance to them after discounting. Okay, and if it is for more than, okay, the bill is pending to be paid, okay, for more than 90 days, it becomes what? NPA. So 90 days is the certain period here. 90 days is the certain period here. If that crosses, if the amount is overdue for more than 90 days, is out of order for more than 90 days, then that asset is called as what? NPA. NPA. Okay, now let us now classify certain assets as standard, substandard, doubtful, loss. Okay, a standard asset is an asset which do not carry any problem, which does not carry any risk, or it is not carrying more than the normal risk what it is. Okay, then those assets are called as standard asset. Those assets are called as standard assets. Okay, see, there are some assets on which income is generating regularly. The borrower is paying the money on time. See, how I can specify this? Assets. Okay, assets can be classified as standard assets. Okay, standard assets. The second side it is NPA assets. Okay, NPA. Okay, non-performing assets. Okay, standard assets. These are the loans. In fact, these are the loans. Standard loans, NPA loans, where the income generation is delayed. Now, standard assets are also divided into, okay, standard assets are also divided into two parts. First part is standard regular. On time payments are made, on time interest is paid, on time installment is paid. Okay, when you can call this as NPA? When the overdue or out of order is more than for 90 days. So up to 90 days, if the interest is paid, then it will be covered under standard asset only. So if it is on time, it is called as regular, but it can be again divided into different standard assets. Okay, those are called as special mention accounts, SMA, special mention accounts, where the interest is getting delayed for, okay, interest is getting delayed for 0 to 30 days, and 31 to 60 days, 61 to 90 days. Up to 90 days, it is not called as NPA. After 90 days only, it is called as NPA. So till that time, the standard assets are divided into regular and SMA. What is SMA? Special mention accounts, where interest or repayment of principal, it may be between 0 to 30. Overdue period or out of order period is 0 to 30. It is not called as NPA, it is called as SMA. And this is special mention account 1, special mention account 2, special mention account 3. So after these days are done, it will be called as NPA. Again, these NPAs are classified as point number 1, substandard, point number 2, doubtful, point number 3, loss asset. Okay, when it will be called as substandard asset? See, when asset which is been classified as NPA, already it is an NPA. Okay, for a period not exceeding 12 months. Already 90 days delay, and from that date, if it is for next, okay, not exceeding 12 months, not exceeding 12 months, it is called as what? Substandard asset. Substandard asset. So up to 12 months it is substandard asset. So after 12 months it is called as doubtful asset. Now let me write here. There is an NPA. There is an NPA which is the interest or principal is paid after how many days? After 90 days. 90 days. Okay, and it becomes what? NPA. Okay, and this NPA continues to be an NPA for, okay, not exceeding 12 months. So after becoming NPA and it is not exceeding 12 months, within 12 months only they are paying, then that is called as what? Then that is called as what? Substandard. Substandard. Okay, now after 12 months it becomes doubtful. It becomes doubtful. It becomes doubtful. Okay, I guess you are all getting the point clear. Okay, and once it is classified as doubtful, again it is divided into 3 parts. Again it is divided into 3 parts: D1, D2, D3. D1, D2, D3. Okay. Okay, if it is more than 12 months. Okay, more than 12 months. So after it becomes doubtful and it is still there for 1 year, still there for 3 years, still there for more than 3 years. So 1, 2, 3, it is more than 3. More than 3. So doubtful is now divided into 3 parts. So doubtful up to 1 year, doubtful up to 3 years, doubtful more than 3 years. Okay, this is how we need to segregate. This is how we need to segregate. So I have segregated that into substandard and doubtful asset. And doubtful asset. What is another type of NPA? It is loss asset. It is loss asset. Okay, it is not having any time period, but RBI or internal auditors or any, okay, inspection agencies, if they declare certain loan as NPA, as loss asset, then it shall be treated as what? Then it shall be treated as loss asset. Okay, if someone declares it as loss asset, then it is called as what? Loss asset. There is no time period which is given here. Okay, for doubtful asset only the time period is given. For loss asset, time period is not given. So when you can call okay, particular asset as loss asset. Okay, when the loss is being identified by, when the loss is been, you can write there, when the loss is being identified by bank, internal auditors or external auditors or RBI inspection. RBI inspection, and it is identified as loss asset, and that amount is not been written off in the balance sheet. Amount been not written off in the balance sheet. It is still in existence even after identification of such asset as loss asset. Then that shall be called as what? Loss asset. Loss asset. Why are we actually segregating this? Only for the purpose of prudential norms. How much amount to be taken as provision? Okay, how much amount to be taken as provision? Provision. Okay, now let's talk about provisioning requirements. Okay, if it is standard asset, 0.4% shall be taken, the 0.4% of that asset shall be taken as provision. Now if it is substandard asset, 15% shall be taken as provision. 15% has to be taken as provision. Okay, now if it is doubtful asset, doubtful assets are divided into, okay, 3 parts: D1, D2, D3. Up to 1 year, more than 1 year, up to 3 years, and above 3 years. Okay, once the asset is doubtful, okay, you need to segregate that into 2 parts. Doubtful assets have to be segregated into 2 parts: secured, unsecured. Once there is an asset which comes under doubtful category and which is unsecured, then 100% provision shall be taken. 100% provision. Okay, once it is secured, then you need to have a 3 percentages in your mind. 3 percentages. D1 25% secured portion. Okay, 25%. D2 40%. D3 100%. So your asset comes under D3, secured 100%, unsecured 100%. D1 25 100, D2 40 100. In case if it is loss asset, Everything shall be written off. Everything shall be taken as provision only. Provision only. These are the prudential norms which are applicable. Now, there are some special cases. There are some special cases where these NPAs are very, very important for audit purpose, where auditor needs to highlight the NPAs because they are showing some assets in the balance sheet, but they are not actually generating. They are not actually generating the income. For that purpose, auditor needs to identify the NPA. Okay, identify the assets which are to be considered as NPA. Okay, he must take reasonable care to identify the NPA out of total assets. Okay, now what you need to understand is, now what bank is trying to do, there is more than 90 days delay, it shall be called as NPA. It shall be called as NPA. Now what bank is trying to do, bank is now, okay, collecting money from the borrower near to the end of the balance sheet date. So as on balance sheet date, the amount is been, okay, collected from the borrower and it won't be shown as NPA as on balance sheet date. But after balance sheet date, again the same is repeated. Again 12 months delay will be there. Say for example, okay, a borrower has taken loan on 1/1/2021. 1/1/2000. Say example 1/4/2021. 1/4/2021. Every month he needs to pay the principal and interest. Okay. So on 31st March 2022, which is the balance sheet date. Okay. So in the meanwhile, this okay, 12 months that borrower fails to make the repayment. Okay. So after 3 months, it will become NPA. It will become NPA. But what bank is trying to do? By the end of 31st March 2022, the assets which are to be taken in the balance sheet, okay, they are regularizing the accounts which are not being paid for entire year. Okay. But they are, okay, regularizing that particular loan. Okay. And they are showing that repayment as on 31st March 2022, so that it cannot be called as NPA. And again in the next year, the same is repeated. 12 months they are not paying. At the end of the period, they are paying. Okay. For 12 months, it is been called as NPA, but as on balance sheet date, it is not called as NPA. This is what they are trying to do. If such case is in existence, then what an auditor needs to do? See, where it appears that account has inherent weakness and few credits near the balance sheet tries to make it regular, the auditor should classify it as NPA. Though it may be paid at the balance sheet date, still it shall be treated as what? NPA only. Okay, NPA only. Okay. Now there is another important point. There is a borrower called Mr. Ravi. Ravi has taken, okay, few borrowings. Loan number 1, loan number 2, loan number 3. Loan number 1 is properly paid. Loan number 2 is properly paid. Loan number 3 he is making some mistakes. Okay, he is not paying anything. Loan number 3. Now whatever the borrowings are made by this particular person, every borrowing will become NPA. Because NPA shall be taken borrower wise but not loan wise. This is the second point. Now advances under consortium. Where 4 or 5 banks came together to provide loan to a particular person. 4 or 5 banks. See, Mr. Ravi has approached. Okay, Mr. Ravi has approached, okay, consortium of banks where the leader bank is SBA. So under SBA there are other banks also. Okay, these all formed as a group. They provided 10,000 crores as loan to Mr. Ravi for his business. Okay, now SBA will collect the revenue and SBA needs to distribute to the, okay, banks which form part of this consortium. Now if your client is this bank called as, say, Punjab National Bank, PNB. Okay, if your client is PNB, then for the purpose of treating that asset as NPA or not, you need to look after, okay, the payments which are received by the banks individually, not to the leader bank. Okay, whether this individual bank is receiving or not, that must be checked. Whether that individual bank is receiving within 90 days or not. If it is not received by within 90 days, then that will become what? That will become, okay, NPA for this bank. So individual bank wise we need to check the NPA in case if it is consortium loans. Now government guaranteed advances. There are some advances which are provided by the bank which are guaranteed by the government. Now if the guarantee is given by the government, then don't treat it as NPA even if it is not paid. Okay, until the government repudiates, like taking back the guarantee, until the okay, government is taking back the guarantee given. Till then, even though the amount may not be paid, it shall not be treated as NPA. However, the credit facility is backed by, okay, state governments, then it is to be treated as NPA only when it is not paid beyond 90 days. So, central government given guarantees, not an NPA. State government given guarantees, treat as NPA if it is not paid within 90 days. Okay, so even in case of central government, when the central government repudiates, okay, cancelling the guarantee, then if it is not paid within 90 days, treat that as okay, NPA only. And agricultural loans, when the loan is given as agricultural loan, okay, agricultural loan, generally there will be two things we need to consider. Okay, the crops will be two types of crops, short term crop, long term crop. What is long duration crop? 1 year, the time taking for complete the crop. Okay, see here, crop season 1 year. See, from the period of harvesting of crops as determined by, okay, to complete the crop process, entire crop process, harvesting of the crop, if it takes more than 1 year, then it is called as long duration crop. Any crop which is other than long duration crop is called as short duration crop. Now, in case of advances for agriculture, when to treat as NPA? It is not 90 days, it is one duration or two durations. One duration if it is long duration crop, two crop seasons in case of short term crops. So imagine Mr. Ravi, a farmer, has taken loan for short duration crop. Okay, what is short duration crop? Less than 1 year. So imagine if it is 3 months. Okay, in 3 months he needs to complete the crop and he needs to pay the money. If he fails to pay for 2 crop seasons, 3 months and 3 months, for 6 months, if he fails to pay, then that is called as NPA for the bank. If it is long term crop, then one crop season must be considered, that is 1 year. Okay, I guess you are all getting the point here. Okay, you can read this. See, I have taken loan from a bank, giving some security. So making some fraud, I have provided the security which is wrong. Okay, so imagine I have taken loan of 1 crore, I have provided a security of 1 crore rupees. However, by fraud I am showing it as 1 crore rupees, but in fact the value of the security is only 50%. See, the value of this security is day by day reducing. Okay, that is called as erosion in the value of the security. See, in the case erosion in the value of the security or in any fraud that is committed by the borrowers. Now, after taking 1 crore loan, he has provided 1 crore security, but later what is happening? The value of that security is getting there is some erosion in the value of the security. It is getting decreased day by day. If that is the case, treat that asset as doubtful asset when erosion in the value of securities by more than 50% of the value assessed by the bank. So previously, when they assessed the value of the security, it was 1 crore rupees. The next time when they are checking the value of the particular asset, it is only showing how much? It is only 40 lakhs. That is more than 50% of the erosion is there. More than 50%, almost 60% erosion has been taken place. Based on that, now you need to straight away keep that asset as doubtful asset, irrespective of whether the asset remains NPA or not. Whether the money is paid or not, whether the repayment of loan by way of interest or principal is paid or not, it is irrespective of that. You need to treat that asset as doubtful when the erosion in the value of the security is more than 50%. Of the value what you inspected for the last time, what the bank inspected for the last time. If it is more than 50%, treat that as doubtful asset, irrespective of whether it is NPA or not. And if the realizable value of the security, comes down to the borrowed amount is 1 crore, but the realizable value of the security is less than 10% of 1 crore. That is only 5 lakhs rupees. 5 lakh rupees. Then treat that asset as loss asset. Treat that asset as loss asset. It is irrespective of whether it remains NPA or not, whether the payments are made properly or not. With that, I just want to go to the next topic. I already explained what is drawing power. Sanction limit is different, drawing power is different. Drawing power depends upon the level of stock you maintain in the balance sheet. That is the stock which is kept as security for the bank, and bank is ready to provide the loan up to the amount which is actually secured in the balance sheet. For that reason, drawing power shall be calculated separately based on after taking into account the margin amount also. So all those will be forming part of the agreement between the borrower and the bank. Next important point for that. So we audited advances along with prudential norms also we are done with. Now I am going into revenue part, income side I am going into. Expenditure side it is given as homework. Now I am talking about income side. Now compositions of income, what kind of incomes will be there? Interest income, interest on bills, interest income on investments. As a bank you need to maintain some balance with RBI, cash reserve ratio, etc. On that, if the bank is getting any income from RBI, see interest on balances with RBI. So mostly on CRR there won't be any interest. However, when the loan is given by the bank to RBI, there may be some cases where selling of T-bills, etc. Where RBI needs to pay the money. And that money is the interest income for this bank. It may be that case. Interest earned. And other incomes. What may be the other income? Bank will earn commission, exchange or brokerage. Exchange commission. Commission. And profit on sale of investments. Profit on revaluation of investments. Profit on sale of land, building, other assets, because bank may own the asset, and if they sell the asset they may get the profit. Profit or loss on revaluation of fixed asset. Here the revaluation of investment take place, here the revaluation of fixed assets will be there. And any other miscellaneous income by way of dividend, because bank is investing in the equity of another company and it may get the dividend. Profit on exchange transactions. So everything will form part of what? Other incomes. So there will be two incomes, interest income, other income. Now as an auditor you need to check whether this income is correct or wrong. Income which is recognized in the balance sheet is correct or wrong. Now you tell me one thing. The dividend or income by way of interest, it is to be recognized as income as per AS9 based on what? Based on accrual basis, on time basis, in fact, time basis. Now, there are some factors to be considered, some points to be considered by the auditor. Now you need to remember for examination point of view, where any advances, with respect to any advances on which the income, whatever the bank is getting, if that income on that advance, if it is exceeding 1% of the total income, 1% of the total income without considering any expenditure on total income, or 1% of the net profit before taxes after considering the costs. Either it can be net profit before taxes or it can be total income. Calculate 1%. If the income from such advance, if it is more than 1% of the total income or 1% of the net profit before taxes, then it should be considered as income on accrual basis as per AS9. If it is less than 1%, it shall be recognized not on accrual basis. It shall be recognized only when it is received. Only when it is received. I hope you are all getting the point clear. So AS9 applicability for banks. So whatever it is there here is total income. So on that apply 1%. Or here what it is there is called as net profit before taxes. On this apply 1%. If and consider there is a balance sheet in which one advance, say advance number 1. On that you are going to get some interest income. If that income is more than 1% of net profit before taxes or 1% of total income. If it is exceeding 1%, then recognize that as for accrual basis as per AS 9. If it is not 1%, if it is less than 1%, then take, okay, recognize that revenue whenever it is received on cash basis. Point number 2, in case the asset is classified as NPA, more than 90 days due date, okay, after the due date, more than 90 days it is been pending, okay, then as per RBI guidelines, it must be recognized as income only when it is received. That is called as what? Cash basis. I guess you are all getting the point clear. Okay, now interest on advances against term deposits, national savings certificates, Indira Vikas Patras, Kisan Vikas Patras and life policies may be taken to income account on the due date, provided adequate margin is available in the accounts. Okay, say there may be some loans which are given by the banks to the parties, to the borrowers. Now borrowers are required to maintain some amount in those accounts. That is called as margin amount. If the margin amount is being maintained by the borrowers, then bank will recognize the income on these accounts based on accrual basis only. Accrual basis is possible only when margin amount is maintained by whom? Okay, borrowers. Now, so outstanding, okay, interest, see, discount income on bills purchased shall be shown, taken into the books of accounts, okay, shall be properly apportioned for the financial year. Okay, now next point, fees and commission earned by the bank. Fees and commission earned by the bank as a result of rescheduling of advances should be recognized on accrual basis over the period covered by the rescheduled extension of the credit period. Say 2 years loan has been provided, and after completion of 2 years it has been further extended to another 2 years. Now the total period becomes, it is 4 years. Now further extension is for 2 years. Now for that extension period they charged, okay, commission of 1 lakh rupees, and this 1 lakh rupees shall be taken as income, okay, for 2 years, not for 1 year, for the extended period 2 years. This is this point. With respect to income, okay, with respect to, okay, investments, now how to recognize the income? We all know we need to recognize the income based on accrual basis only. Where it is non-performing asset, it is to be recognized on realization basis called as cash basis. Only when it is received, when the income is received, then only you need to recognize it as income. Okay. When the investment is guaranteed by whom? Central government or state government. Okay, those shall be recognized as accrual basis. However, where the interest is not serviced regularly, such income cannot be accounted on accrual basis. Now you need to, okay, consider one thing. When the loans are backed by central government or state government, when the, okay, even though there may be pending repayments of installments or repayments of interest, okay, still that shall not be treated as NPA. In case of central government guaranteed. Okay, in case of state government guarantees, it shall be treated as NPA only. However, though it is not treated as NPA when it is backed by central government guarantee, but still the income has to be recognized only on cash basis when the payments are not regular. It may not be treated as NPA, okay, but the recognition of income shall be based on cash basis only, but not the accrual basis when the, okay, when the interest is not paid regularly on time. That is what it is to be remembered. Okay, now the next point, when the dividend shall be recognized. Okay, this banking company has invested into another company by way of equity. Okay, the other company has declared the dividend in their AGM. Once it is declared in their AGM, then only the bank can recognize that dividend as income. Okay, this is also discussed in AS 9 only. This is covered in AS 9 in fact. AS 9, when to recognize the dividend as income. Okay. Next point, income from mutual funds. The investment is made in units of mutual fund, and in return, when they can, okay, treat that as an income, okay, based on cash basis. It is not accrual basis, it is cash basis. Okay, it may be given for examination. Last point, profit or loss on sale of investments to be taken into P&L account. Okay. Now, some important points we need to remember. Income. Okay. Already you recognize something as income, but that asset has become NPA in the subsequent year. Say on 31st March 2000, okay, on 31st March 2022, there is some advance. It is not an NPA now. Okay, because it is not an NPA, okay, the income on that advance is taken, okay, as income in the current period by way of accrual basis. But later in the next year, this advance has become the NPA, and in the previous year, the income on that NPA, okay, has taken into P&L account of the previous year. Now it shall be reversed. See, first time NPAs. If a loan or advance is treated as NPA for the first time, interest accrued which has not been realized, accrued but not realized, but credited to the income of the previous year, that income shall be reversed now. Okay, there is an NPA, there is a advance as on 31st March 2021, it is not NPA. So that based on, okay, accrual basis, on accrual basis I recognized it as income. Now in the next year it becomes NPA. Now whatever I already recognized in the previous year shall be reversed in the current year, because the asset has become now an NPA. So that is after 2021. That is first point. Now interest is recognized on cash basis. So when the interest, see, now in the next year it has become NPA. Once it becomes NPA, interest will be recognized only on cash basis. Okay. When the interest is recognized on cash basis, then any commission or such other income from the same, with respect to same borrower, which has been recognized on accrual basis in the previous year, okay, that also shall be recognized, reversed. That also shall be reversed. So when the interest is reversed, the simultaneous commission shall also be reversed. So whatever the other, okay, incomes that may be generated by the bank from that particular borrower, okay, everything shall be reversed. When the interest is reversed, everything shall be reversed, whatever the bank is going to collect from them, from that particular borrower. Next one, finance charge or leased asset. It is not that relevant for examination. Okay. Now we are going to identify the revenue, audit of revenue items, that too particularly expenses. Different types of expenditures are given. So easy. Okay. Particularly you need to answer, you need to write few points. Point number one. You can just read on your own. So all these points you can just read. But one important point you need to write is apply analytical procedures on the expenditures to compare with the previous year expenditure, so that the auditor will come to know whether it is increasing or decreasing. This one point, it is most relevant. From my side, you can write this point, analytical procedures. Rest all it is given as homework only. It is so simple. Okay, interest expenditure, interest income we have verified, income expenditure now I am asking you to verify. Okay, point number 2, operating expenses. To run the banking business, they need to incur certain operating expenditures like salaries, etc. Okay, how to verify that? Normal point only, check the internal control system. Okay, check the major items of expenditures, perform analytical reviews, analytical procedures. Okay, verify expenses with documents, okay, evidence, etc. So easy only. So these 3 points are given as homework. Okay, so under expenditure 3 parts are there: interest expenditure, operating expenditure, and provisions and contingencies. Okay, one more important point is comply with RBI guidelines when you keep certain provisions. I already told you prudential norms are there. 0.25%, 0.4%, 100%, many percentages are there. So as per the guidelines of RBI only, whether we are treating or not, we need to check. Okay. With that, I just want to wind up this chapter called as Audit of Banks. Everything is discussed in detail. Okay. Okay. For the examination point of view, I think it is sufficient. With this, I just want to wind up the session now. Okay. Done. Thank you.